Bonjour, mesdames et messieurs. Good morning, distinguished delegates. Welcome back. Welcome to the second day of this ICTD conference and final day of the 4-day event. First of all, I hope everyone is wide awake and ready for this final day. I, for one, I am quite excited. Just to give you a quick recap of what we learned yesterday, we spoke on the importance of data quality and paying attention to business objectives in data governance and keeping in mind inclusivity in the journey of digitization, especially since it's no longer an option, but a must, a way forward for everyone. That's just a quick recap, and I think you do have the agenda if you want to just quickly look at it. If you forget anything, please feel free to do so. Now, I'd like to make an announcement before we have the first scene setter for the day, basically our group for the next session. We are going to be taking a group photo just before lunch, and it's going to be taking place right here on the stage. Please keep that in mind. When we're going for lunch, before we go to the marquee, we come forward and we just take the group photo first, please. And if you don't wish to be part of the photo, as mentioned yesterday, feel free to please inform us. That's okay, we won't take any offense. For the first session of the day, we're going to be talking about improving data quality and integrity, digital ID systems, and taxpayer registration being the core focus. The session will present a policy-oriented panel discussion on the potential of digital ID data and systems to strengthen tax administration's core functions, namely tax registration, identification, and to improve the quality of tax administrative data. Our scene setter will be Celeste Scarpini, who is a doctoral fellow from the ICTD. She will have a 10-minute scene setting. And then our panel will be made up of Tina Kaidu, manager from the Research and Revenue Modeling team from the Uganda Revenue Authority, Sintayehu Mitiku, Digital Transformation Advisor from Coldwater International, and Kwame Fianco, Head of Data Mining and Analytics from Ghana Revenue Authority. Our moderator will be Anders Agerskov from Tax Policy Department of the World Bank. If our scene setter could please come forward, and our panelists, just as I called you, please take a seat on stage. Welcome.
Good morning, everyone, and welcome to this panel on improving data quality and integrity, digital ID systems, and taxpayer registration. So, as we know by the beginning of the second day of this conference, the pillars of DPI are three, and they are digital ID systems, data exchange systems and integrations, and digital payments. Digital ID systems and data exchange systems are quite core to one of the functions of tax administration, as I have learned in the past years of research. And this function is taxpayer registration. Data exchange, which works thanks to a data exchange system and integration between the revenue authorities and various other third parties. Importantly for this registration, national identification authorities, and the data that is exchanged to these parties, it's used for taxpayer registration, which is often a mass registration effort, meaning that increasing very, very high numbers of taxpayers are registered for tax purpose. So as I have learned through engaging with our revenue authority partners, this can happen through 3 different channels. So first, there is an ad hoc data exchange, whereby at registration point, when a taxpayer applies for a tax identification number, the data from the National Identification Authority is pooled and transferred to the revenue authorities for registration purpose. Then there is a systematic channel whereby the National Identification Authorities can share data to the revenue authorities as soon as a taxpayer turns 18. And then there is also registration of taxpayers through other kind of third-party data that comes from different sources, such as service providers, other ministries, local government, and so on. And basically, it works in a way that revenue authorities can identify or presume that there's some economic activity by looking at this third-party data and automatically register taxpayers. So a very important distinction in taxpayer registration is to know that taxpayer registration can be voluntary, and therefore the data exchange helps. It's basically embedded in the tool for registration, which is, however, voluntary registration of taxpayers, or taxpayers can be registered automatically when the data shows that there might be some economic activity that is undeclared. And therefore, I will call them interchangeably forced registrations. So I am going to present insights from ICTD research on these themes, and specifically I'm going to talk to you about the impact of data exchange for registration purposes on registration numbers, new tax categories of new taxpayers, quality of data in the registry, and revenue collected. So to start with, we can see from these graphs that in 2021 and 2022, when data exchange for registration purposes was embraced by the Uganda Revenue Authority and the Ghana Revenue Authority, the numbers of new taxpayers in the registry expanded massively. In Uganda, we can see the red bars. They are third-party driven registration, but not through the identity data. So they come from a range of various third parties, while the green bar is registrations that happened through the exchange of data between Identification Authority and the URA. While in Ghana, we can see that also in this context, registrations exploded. They were incredibly high, and especially the purple bar represents the registration obtained both voluntarily and automatically through national identification data. Looking at categories of taxpayers that come in the registry thanks to these modalities, we see that generally these taxpayers are more likely to be part of those categories that are generally more difficult to reach for the revenue authority, such as rural taxpayers, younger taxpayers, female, and those that were previously having an informal economic activity. While specifically for voluntary registrations, we know that these are taxpayers that are businesses that are more sophisticated, more tech savvy, and they are more financially included. So we see that these techniques, this data exchange, can bring to the tax net more categories that are more difficult to reach for the revenue authority, and in some cases can facilitate compliance given the more quick process through which data exchange enables registration. Going to the data quality, we see that voluntary registration through national ID data have a general positive impact on data quality. In fact, the number of duplicate tax identification numbers is reduced, and there are less inaccurate or invalid contact details. as well as there is an expansion of information about taxpayers, such as age, gender, or physical address. However, there's the probability of having good information about economic activity and sector of activity decreases with this kind of data exchange. And this is due to the fact that the data that is acquired by the revenue authority is not meant for the purpose of estimating and identifying the extent of the economic activity and its nature. And it's also important to note that these registration efforts come also with, generally, with an expansion of the tax cleaning, tax registry cleaning and maintenance team, and therefore the improving data quality can also partly be attributed to these efforts. Looking instead at the forced registrations, we see that the impacts on data quality are quite negative. In fact, the same outcomes are deteriorated with forced registration. We have more invalid and missing data on the nature and size of economic activity, and the same is true for contact details of taxpayers. This as a very significant cost for the revenue authority in terms of administrative processes to maintain and clean the tax registry, which is something that should be taken into account. Looking at tax revenue instead, the forced registration have very I mean, we can see that taxpayers registered through forced registration have much lower compliance propensity than usual registrations, and this is probably due to the lack of low capacity of the tax administrations to onboard these taxpayers and to make them start the compliance journey and eventually enforce compliance on them. And this is linked again to the issue of data quality. When you have poor taxpayer information, when you don't have their contact details that are valid, you're not able to reach them out and invite them to start the compliance journey. Instead, when we look at taxpayers who are already in the tax net and just shifted from a traditional tax identification number to the unique identifier that is given by the personal identification number or national identification number, however we want to call it, we see these taxpayers have much better compliance outcomes. But this is probably due to the fact that they are inherently more likely to comply. They are already in the tax registry, and so somehow different from those who were brought like automatically into the tax registry. But it's also true that they behave. They have better compliance outcome compared to standard registrations. To those who didn't shift. And therefore, it might be true that integration has worked as an enforcement device for them. I think this research, again, tells us that technology and exchange of data for registration purposes is not the silver bullet. The outcomes of it depends very much on how it is used. There are three broad implications of this research, I think. So firstly, that it's important to consider the context in which we implement data exchange for registration purposes. So it's important to understand what's the current state of the tax registry, what is the opportunity cost for the revenue administration to embark in registration efforts, and what is its administrative capacity then to deal with the implications of it. And also, most importantly, I think, it's important to consider the state and the nature of the data that is acquired through data exchange. It's also, I think, quite relevant to reevaluate the targets of mass registration campaigns, because they risk to take the focus away from more high potential taxpayers, which in many cases might already be in the tax net. And then it's important to consider that the registration is the start of the tax-paying journey, and therefore revenue authorities need to continuously engage taxpayers after registering them. And to guarantee compliance, they also have to continuously try to improve taxpayer services. So, yet to conclude, I think the benefits of these data exchange efforts can materialize, but when they are fit for purpose and when also the challenges that are persisting are addressed complementarily. Thank you very much.
Thank you very much, Celeste. Please join us here at the stage. What I really like about Celeste's work and that of ICTD is that you bring empirical rigor to our work, right? We, as tax professionals, we have certain ideas, things we hold true, but we often don't have the time, the skills and the tools to see whether those senses can actually be backed up empirically. And I think a key insight from your work, Celeste, is that we have to think very carefully about registering unregistered taxpayers. So if we don't know if they're engaged in economic activities that is taxable, then we may be creating more work for ourselves without any results to show, which reminds me of an insight from a former HMRC colleague. He said, you know, data is like plastic. There's too much of it, and it's hard to get rid of. So the issue is the more data we ingest, the more effort we have to spend in understanding and cleaning it and so on, right? So we have to be very careful about that. So this session is about tax IDs, about registration, knowing who our taxpayers are. And why does that matter, you can say? Well, it might be obvious, but it brings me back to a conversation I had with Tyson Fawcett, who was a senior director with the Australian Taxation Office, and he said to me, Anders, can you tell me which is the largest profit center at the ATO? So I gave it a bit of thought and said, well, that would, of course, be audit. He said, no, it's our analytics department. Right. So analytics works often by matching different data sources. And that's how it adds value. We know, for example, from the United States, if you look at compliance levels, that if you don't have withholding taxes and no third-party reporting, compliance is in the single digits. But if you have third-party reporting and withholding, then it is in the 90-some%. So that's why TINs are really, really important in driving also voluntary compliance, because if you know your employer is sending information about your salary, you know, maybe you should go to the Revenue Authority and come clean, right? So it has also a voluntary component. On the TINs, ICTD and us are preparing a paper on this, on how you go about designing your TIN, what are the different design options, and so on. As part of that research, we looked into, you know, how does it start out in countries? And where I currently work, the United States, where it started out was not with the tax authority. It started out with the Treasury Department. So you may ask, why did the Treasury Department do this? Well, because they were worried about paying money out to contractors that owed taxes. So they instituted an offset policy. So if you were going to pay $320,000 to a contractor and they owed $120,000, well, you're only going to pay $200,000. So it's a very pragmatic thing, which also brings up the theme that will go through our discussion today. How does the tax authority create a win-win relationship with other agencies that have an interest in the tax data, and they have an interest in the data that these other agencies have? So what I would like to do here with our panel is to take a round of interventions, and I ask them to reflect on the TIN system and the win-win in each of their jurisdictions. And I will also ask you to briefly present yourself. So if any of you have questions afterwards, you kind of know what our colleagues are working on and you can grab them. So let me start off with you, Tina. Can you talk a little bit from the Uganda Revenue Authority side about what these win-win relationships look like in terms of registration of taxpayers, pensions, and addressing the challenges of the informal economy? Thanks.
Thank you, Anders. Good morning, ladies and gentlemen. I've been introduced, and I'm honored to be part of this panel. And indeed, like you've mentioned, digital ID systems have, supported by interinstitutional data sharing, have played a transformative role for tax administration in that it has enabled simplification of the registration process, facilitated sharing of data, and enhanced the data quality, and has also helped us formalize the informal sector. One of the benefits that we have seen with sharing of data and interinstitutional cooperation is that we've seen efficiency in registering our taxpayers. And as the scene setter indicated in the presentation, we have the instant TIN in the Uganda case. And when we integrated with the National ID Registration Authority, we were able to validate the data for new registrants by using the instant TIN platform. We reduced the turnaround time for obtaining the TIN from so many days to instantly obtaining the TIN. So a taxpayer is able to immediately transact after obtaining an instant TIN. So for us, that is a plus as a revenue authority, in that we're able to grow our tax register. But at the same time, that integration didn't stop at the individual level, but through collaborations with the company registry, we're able to integrate the instant TIN for individuals and the database for the company registry. And in there, we have seamless exchange of information, and we are able to eliminate duplicates within the system, and also have reliable data. Now, when you look at the company registry information that we've been able to obtain as a revenue authority, we are able to access more records within the registry of unregistered businesses that are conducting businesses out there. We are able to identify the beneficial owners plus their identification and contact details. So really this to us has been a plus as a revenue authority in terms of growing the register, but at the same time in ensuring transparency within the registration process. Of course, in addition to identification and registration, we've also seen that we are able to enhance compliance and enforcement because we verify the declarations and expenses that are declared at the company registry level. We are also able to reduce that administrative burden of going out to look for these businesses because they have already been registered by an institution that is a government institution, and this has eased our processes in tax administration. However, you find that government agencies have distinct mandates when it comes to collecting information and building their various data sets. And they also have various targets. Some are revenue in nature. So you find that because of these distinct mandates, the actions of one agency can impact on another. An example I can give is if there are incomplete records in the company registry, this can impact the quality of data that we have in the tax register. So tax administrations and probably also other agencies may face a challenge of identifying the rightful owners if they are incomplete records or inaccurate records. But also sometimes this collaboration or cooperation may disadvantage one agency. For instance, if the tax administration would like to probably validate it may take time to do that, and that may impact on the revenue that is being collected by the company registry. So it's crucial that these interactions between the different agencies take the approach of a whole government approach by not looking at the things that disadvantage them, but look at the overall benefit that comes from interagency cooperation. So, yes, we feel that tax administrations should be supported to obtain this information because overall we collect the revenue that supports all the other government agencies, even when they also depend on NTRs to really support their business, their operations. But even then, the NTR, the non-tax revenues are maybe insufficient. So when we are looking at cooperating in sharing data and collaborating on expanding the taxpayer register, it's important that we look at the overall benefit. So a holistic approach is something that we recommend for efficient resource allocation. Thank you.
Thank you very much, Tina, and I think that's an important point. Just to take you into discussions at the World Bank, we've had for many years something called doing business analysis, where we talk about how many steps does it take to register a company, how long time does it take, and obviously fewer steps, faster is better. But there's a trade-off on the tax side. So for example, having worked with Latvia, they're very concerned about organized crime units establishing companies as part of carousel fraud. And so they have significant checks up front at the registration side. So that's where it's very important for the company registry and the tax authority to work together. And if the tax authority has concerns about that firm, to bring that up front. And that's where the interdependence comes in, and I think that's very important. I think we should also come back later to the whole issue of beneficial ownership and how that relates to tax IDs. I think that could be an interesting discussion. But let me pivot over to Kwame. And Kwame, can you talk a little bit about how you set up these data exchange system, how it impacts on your country's filing, and maybe go in, I know you have some thoughts on a data exchange with the Social Security Administration, you know, what that is yielding you and how it's helping them do their work. Thanks.
Okay, thank you, and it's good to be here. Thank you to ICTD for inviting me here today. Yes, with the digital ID system, the setup within Ghana has been a very broad government initiative, of which the Ghana Revenue Authority has been a key beneficiary of that. Some of the benefits are inherited by the share structure of this. So essentially, as we may have noted yesterday, the purpose of this was not initially intended to be adopted as a tax identification number, but as a registry, an ID system for citizens. But the thought of it being used to drive the general government services was something that drove the build of that infrastructure. So some of the benefits we inherited from this is that thought process that was supposed to ensure that government services are able to integrate this as part of their core business activities. When you look at with the Ghana Revenue Authority, to be specific, it's more on the individual side, the individual taxpayer registration side. So we have some sort of API integration with the National Identification Authority, where, as Celeste indicated in her in her piece, we get data from there once a citizen is 18 years and above, and that comes into a centralized portal. So that doesn't go directly into the tax administration system. It comes into a centralized portal where matching with existing taxpayers occurs, because we've had a legacy issue of taxpayers having multiple taxpayer identification number for several purposes. So our first instance is to weed out all those duplications. So multiple IDs will be linked to one personal identification number, which is the Ghana card number, which has been adopted as a tax identification number. And then now that now represents the activities of the taxpayer when it has to do with tax-related activities. For onboarding purposes, the same portal is used, right? But in this case, it enhances the registration process because the authority would have some data on you already. The authority basically has a structure where one will call like a relationship officer or a taxpayer service person will walk you through that and interview you so that they know the appropriate tax types to register you for, and then you're onboarded into the system. So that is how in terms of the exchange of information, that is how we've structured it. It is API based. We get data once you are above 18 years and above, and it enhances the registration process in this way. Without the duplications, and then enhance or streamline the process of registering you as a taxpayer. Now, the next leg of it is you as a taxpayer undertaking your tax payer obligations. That's your filing, your payment, and all of that. And this has also been integrated into that whole process. Taxpayers typically would have to have a taxpayer portal, and this helps us to be able to validate who you are and also be able to share your OTP with your phone number that comes with the registration, especially comes with the digital ID details, so that you can validate yourself and then get registered on the taxpayer portal, where you can now undertake your filing and then your payment obligation, and even generate your tax clearance certificates from there. It's been, when we started, I think for the past, we've been at this, I think, for the past 4 years. We run it parallel with the existing process. So once you are unable to, you don't have the capability of doing this by yourself, you run to the Taxpayer Service Center, and then an officer will help you to go through the process. If I would go, I'll extend this a bit. We also establish a data exchange capability with other government institutions. And as I said, so that this is not taken from the point where it has been the core, the GRA has been the core center of these exchanges. As I've indicated, it's a broader government initiative. So you'd see that, for instance, a case I would like to talk about, if you have to register for a phone number with the telecoms, you have to do that with your national ID as a citizen, right? So every phone number, right, has a national ID linked to it, and it can be linked to as many as 10 phone numbers, right? So what that does for us is that it gives us additional capabilities for integrating data across various government agencies. So I'm sure my colleague Isaac will talk about this later on. So with our e-levy system like this, once you transact, for the data that the GRA receives, your transaction details are there, your phone number, which is also linked to your the task identification number, which is also your national ID number, is there. And because if you also want to have the ease of transacting between your mobile wallet and your bank account, that is also relevant for that integration, right? We're able to benefit off these other details, right, to leverage on to undertake data exchanges with other government agencies. As I said, from where we started, there were definitely going to be gaps in data in various government agencies, and some of these data points help us to be able to fill those gaps. If I have a minute more, let me talk about some of the win-win situations that we have enjoyed as part of this whole setup. So, for instance, we are undertaking real-time exchanges with API based with the pensions or institution. That's the Social Security institution in Ghana, and this has become very crucial. The infrastructure we have has become very crucial, and then the sort of data points that this initiative has touched in exchanging that data. So, for instance, the pensions institution is interested in verifying, because it's regulatory for every institution to register with the pensions authority and also to remit contributions for its employees. How we're able to benefit from this is we're able to leverage on the national ID system, which is the tax identification number. And because the broader initiative has also mandated the pensions authority to replace the social security number with the national ID, we're able to verify whether institutions are actually submitting remittances of actual individuals and are not shortchanging what they are supposed to do, right? They're able to also verify the values that are being remitted, right? Because on one side, one is paying income tax. On the other side, one is remitting one's pension information. The authority on the other side is able to verify the accuracy, right, of the income tax that is being filed and paid to the authority. And on the other side, the Social Security institution is able to also validate the accuracy of the information that is being sent to them and then the amount that are being remitted to them. So these are one of many cases that we might be able to explore here. Thank you.
Thank you very much, Kwame. And let me just emphasize two things that you brought up. One is on the multiple IDs. I mean, yes, there's an issue if one company has multiple IDs, but it's also a complex world. I had recently a conversation with the American Revenue Service, and I said, well, what's your experience with IDs? And they said, well, there are multiple. Let me give you an example. We're right now looking into a company. It has a TIN in one state. It has a company registration in different states. Its operating license is in a third state. Its headquarters in a fourth state. And the major shareholder is in a fifth state. And it has recently merged with another company that had another TIN, right? And it has multiple branches. So you can see there are multiple identities, right? And we think it's a company, right? And then if you add the directors and so on. So it gets complex without even introducing the fact that you can have one taxpayer with multiple IDs. And I also like the pension fund example. And it underscores the win-win situation. So if you know about income in the tax authority and that income is related to the pension contribution, that information is important to the pension fund, right? Because they can say, oh, you earned so much, you only paid this much in, that may be an issue, right? And the other way around, well, people pay a lot of pension in, but it's not really matched by income data on the tax authority side. So that's where these win-win relations come in. Since Yahoo, reflecting on your experiences around digital IDs, establishing the tax base, which is extremely important because that's ultimately what the TIN is about. Can you first explain a little bit about your current role, position, and your insights into those types of issues?
Thank you. Good morning. My name is Ntayo. I specialize in that intersection between tax and technology, which is basically also the theme of this conference. Thank you, Celeste, for the scene setting, and ICTD for inviting me here and to learn a lot from our colleagues, and of course the Rwanda Revenue Authority for the warm welcome and the opportunity to dance as well. I think a digital identity and digital IDs are opening a lot of doors for specifically for tax administrations. It's been something that we've been suffering a lot from, and think about expansion of the taxpayer base, or think about building a holistic, or as we call it, a 360 view of a taxpayer, or even detecting and confirming inactivity. When it comes to taxpayers, we can have a number of instances, a number of situations where tax administrations can tap on or can benefit on digital IDs. Just before I go there, maybe on this the parallels between forced mass registration and the opportunity that where this national IDs are creating. It's beyond actually data quality. It has been like the case has been registering more and more and more. For example, where I'm from Ethiopia, about a decade and a half ago, there was this forced registration, mass registration campaign, which ended up having about 7 million individual taxpayers with biometric data. Unfortunately, about 300 to 500,000 of that has managed or transitioned into actual revenue. The rest has never been used, and I think that experience is, in fact, what we have learned later on was having that data. Of course, it was expensive, but maintaining it was increasingly expensive. For almost a decade and a half, the country was paying close to $400,000 just to maintain the licenses for all of those registered taxpayers. So we have to be kind of careful when we talk about this mass registration. We have to really address the question: are we ready? As a tax administration, are we ready to also go beyond the registration and address the other aspects of tax administration? I think the same thing can be said about data. Yesterday, everybody was talking about, it really was relevant, everybody was talking about having more data, let's get more data and whatnot. But the question is, do we have the institutional capacity to make use of it? And do we really have, not necessarily, just technical capability, but, the mindset, that's outcome or business-oriented, need-oriented starting point and whatnot. Related to this is maybe, Kwame, you can refer to it later on, the integration between Ghana Card and the team. It opened a lot of doors. And Celeste, you mentioned, for instance, how this digital ID data is not fit for purpose per se for tax administration. I think there is a case in Ghana where, among the other data elements that you are asked, you're also expected to share your occupation, which could be one of the indicators to say your tax position. It's not the only one, but at least one of them. And potentially you have like 18 million taxpayers, of course, should be verified and vetted before it continues. Specifically on digital IDs, there is its ability to uniquely and unambiguously, to borrow the word from the ICT research, to uniquely and unambiguously identify, in our case, a taxpayer, and to verify the taxpayer, and to track the taxpayer. That's really impressive. And that's why, it is one component, one of the building blocks of a DPI, one of the 6 building blocks of the tax administration 3.0. and closely related to what we call the performance outcome area 1 in TADAT assessment, okay? It's something that a lot of tax administrations have been suffering from. It's something that I think a lot of them are understanding that, there are easier ways in terms of collaboration, in terms of, partnerships and whatnot. Now, if we can see a little bit, beyond registration, okay, we have amassed, even new registrations with this digital IDs. What can we do with this, okay? I want to talk about just, 2 or 3 points. First one is the fact that we have national IDs is opening, it helps us to carefully expand our tax base, to carefully expand. So it's not mass registration, it's not, that everybody has a national ID that means, corresponds to having a TIN or whatnot, but a careful expansion of our taxpayer base. For instance, in Ethiopia, there is a project, a national ID or a digital ID project office, which in the last about 2.5 years have registered about 10 million individuals. And in parallel to this, the government is mandating the use of the national ID in services. For instance, right now, you want to register your property, it means you need to have national ID. You want to get a TIN number for tax purposes, again, you need to have your digital ID, okay? Or as they call it, FIDA. So while we can discuss, the benefits and the pros and cons of this, mandating it, but the tax administration now has a chance to see sectors which have been completely invisible. Okay, for instance, behind every property transfer transaction, usually in Ethiopia there are brokers, which are entirely in the informal sector without any clarity, where the tax administration has no idea about. So that helps, potentially will help the tax administration to expand, its taxpayer base. The other is in terms of the holistic view. Okay, we often talk about this 360 view of a taxpayer. I don't know which tax administration can confidently say that, yes, we have, a 360 view of the tax administration, the taxpayer, because it's also kind of evolving, But those, B, C, D, E things, like the behavioral aspects of a taxpayer, the compliance aspects of a taxpayer, the demographic aspects of the taxpayer, and the economic aspect is all, that this digital IDs can serve as that link, that glue, to help us understand the taxpayer beyond, the tax administration, outside of the tax administration, be it in the banks, be it in customs. Often we say customs is within the said tax administration, but we really are not, that's an entirely, separate entity with its own systems and whatnot. Now connecting them with, this digital IDs can be of help. Maybe the last thing when it comes to this services is inactivity of taxpayers. Okay, the inactivity of taxpayers. So what we do in our database, in the taxpayer, in the tax database, there are quite a lot of inactive taxpayers. However you define it. Okay, however you define it. Now this digital IDs actually open a door because, let's say, for example, for individuals, by connecting with, and verifying the taxpayer, the existence of the taxpayer, it could be, a deceased person that we are talking about, that we are considering as, an active taxpayer in our database. So even to detect inactivity and possibly proactively prevent it, okay? Proactively predict it and prevent it. This could create an opportunity. Finally, when it comes to a win-win situation, maybe starting with the end in mind, okay? Because everybody now is talking about the technology, but the technology is here to serve something. It's a tool, right? Maybe having that end in mind as a starting point when we are thinking about third-party data, or when we're thinking about collaboration with other parties is important. Alignment of business processes. In my small experience, I've seen many tax administrations invested a lot on APIs, on technology, and connecting with others as well, but the business processes are not connected. So it's just the technology that's sharing data, but the technology, again, it's here to kind of automate the business processes. Maybe Kwame, you can reflect on that a little bit more. And finally, in Seychelles, for instance, right now they are exploring the possibility of using national ID as a glue between the pension fund and the revenue commission. What that means is a taxpayer, an employer, should only submit a payroll only at one location, only once, okay? Could be at the pension fund, it could be at the revenue authority. Immediately, that data will be automatically shared with the other party. So what this means is high integrity, data, a similar, a consistent data across the two organizations, and more importantly, the ease of compliance from the taxpayer perspective. Thank you.
Thank you very much for a rich set of comments. Let me just, I want to open it up now to questions. And while you're thinking about your questions, let me just emphasize a few things you said, Santiago. One is the cost of data. It costs money to collect data. It costs money to maintain data. It costs money for licenses, right? So I think that's a very important point. Second thing is you talked about using data, which brings me back to an experience I had. We were trying to figure out how do we prevent fraud, just looking at our investigations, and we felt very good. We came up with a kind of a set of filters, like 20 different questions we would ask. And then the question came up and said, well, how do we know if they're effective? So we looked back into our investigation cases, and we found out that only 4 of the filters were really effective in detecting the things we found during investigation. So looking at the data, what is really critical? What data are we using to make decisions, as opposed to it's nice to have, right? And nice to have is really an enemy of risk-based work. I also want to highlight the mandatory use of IDs, because if the government mandates the use of TINs or other ID numbers, it means that people are forced into the data ecosystem, right? And it becomes more difficult to tell different stories to different people, right? So that is very, very important, and that's why the tax authority has an interest in doing this as a whole of government approach. And there's also another one that we have seen in the bank, which is taxation is about the social contract, right? So if I'm part of this community called Rwanda, well, then I also pay my taxes, right? So very specifically, one of our partners in a local market wanted to tax the merchant. So the conversation was, how much? So there was a dialogue with the merchants. The merchant said, well, we want to pay daily because then otherwise it adds up to too much and we can't handle it. But it also ended up with the government providing the services to the merchants before collecting the taxes. So often we don't have that kind of social contract, but it's implicit here. People expect services for the tax money, and we're moving. So we cannot, as tax people, ignore that fact, right? So very important point, Santiago. Let's open up and hear questions from the audience, please. Fabrizio? One person whose name I know.
Thank you. A quick one. Shall we aim to totally replace TIN and substituting them with PIN, with the ID number, or as in Ghana, right? Or would it still make sense to keep having TIN which are connecting to PIN? Thank you.
Okay. Good. Good question. Gentleman in the back. No? Oh, yeah, please.
Thank you. So I would like to ask a question to Alan. So concerning the how to continually ensure data accuracy, to increase the data quality at the tax administration side. That's the first question. The second question goes to Kwame. So concerning the validation of data, so can you elaborate how to determine the best techniques to be used when validating the data relevance for the tax administration during the integration with the other institutions?
So the second question was around data mining or how to understand the data coming from third parties, or how to use the data?
What are the best techniques to determine
best cases to
validate data relevance?
So
the relevance of data.
Yeah. So best use of the third party data for compliance purposes. Yes?
So my concern was when you are going to integrate with the other institutions, they have a separate mandate. So, and then to be able to know which data are relevant to you, you have to go through the data and check which one are necessary for you. And then what are the best techniques to determine those data which are relevant to you?
Yeah, exactly. Good. And the first question, I didn't get that quite.
The first one was about the data accuracy, contrasting it to the data quality. So how to continuously ensure that you have data accuracy when you're contributing to the data quality.
Okay, good. That's clear. Thanks.
Okay, so my question goes to Ethiopia. Yeah, so data matching is supposed to help actually broaden the tax net. That is to say, help bring in taxpayers who hitherto were not within the tax net. So for instance, Ghana, Kwame explained, so we get the data from National Identification Authority, and the information that we get from there is enough to be able to say, okay, this person has a business and not paying the tax, and then you can pursue the person. So for Ethiopia, I want to find out how you're able to identify potential taxpayers and how you bring them into the tax net to be added to the existing taxpayers using your system. Thank you.
A quick question, please. So a large part of the economy in Nigeria is informal. This makes it difficult for taxpayers to be registered and to track them as well. So my question is, how can the digital ID systems be designed to include individuals working in the informal sector? Thank you.
Okay. My question is to throw a bit more light on Fabricio's question, whether it is still relevant to have a TIN separate from the national ID. In the case of Ghana, we have some kind of a case where we are required to register non-residents, especially for non-resident businesses that are operating in Ghana. And in the case where the non-resident doesn't have the national ID, what happens? So we are still having cases where the tax authority is issuing out the previous 10 for exceptional cases where they cannot have the national ID. So at the background, we still have the case that Fabricio is talking about, where the national authority is, the revenue authority is still issuing out the old 10 for exceptional cases. And even cases where we have children who haven't attained the legal requirement to get a national ID, then the revenue authority is providing that. So it looks like we have both operating side by side. So Kwame will offer more light when it gets to that. Yeah.
Thanks. I've noted kind of 5 broad areas, and I would just give our speakers and also Celeste an opportunity to weigh in. So while you're thinking about your responses, let me try to paraphrase them. So first, can we just replace TINs with other IDs, or to elaborate a little bit on this, where can we rely on other type of ID systems, and which are the specific circumstances, like you mentioned, foreign citizens and children, where we need a TIN? Where do we need a TIN because there's nothing else? I think the second question is, how do you know what data third parties have that are really important to you, right? Whether you're talking about banks or pension funds or what have you, what's in their databases that you can make use of? How do you figure that out? The third is on data accuracy. So I take that to mean, how do you validate the accuracy of third-party information, or use that third party to validate your information? If it's not matching, which data do you use, right? How do you know, how do you have confidence in your data quality? And another issue is around the informal sector, right? So how do we think about the informal sector? And I will also ask you to think more carefully about the different aspects of the informal sector, because that's very broad. It could be people working in the agricultural sector, it could be large companies hiding in the informal sector. So if you could kind of nuance that a little bit. And then I think the last question would be, you know, on Ethiopia, but also other countries, how do you bring taxpayers into the tax net? I mean, how do you know that there are potential taxes they're evading rather than it's some ID you're getting from somewhere? So maybe we'll just turn it around this way at this time. Starting with you, Senator Yehu, any thoughts on those questions?
Yes, thank you. On Fabrizio, on replacing things with, you know, other identities, I think it's really better to really understand the cost benefit, because it might not be it's not the end of the world if you have multiple IDs, as long as you have some glue connecting them, right? And so that transition, that change management that you are bringing has to be well compensated with the benefit that you are, getting if you are transitioning, changing your ID systems. And in tax, it's also a bit sensitive. Okay, it's also a bit sensitive. So probably better to look at that. In terms of data mining, when it comes to data, and we have a lot of it, by the way, in tax administration. We are yesterday we discussed how tax administrations are probably the earlier adopt technology, from comparing it to other government agencies. So that means we've been collecting a significant amount of data. Now, to analyze that data, to get some insights, or even to get more from external stakeholders, we just have to think about the business goals, the business case. Why do we need this? Because when you understand that this is the missing data, then you start looking at where can I get it, okay? Where can I get it? And of course, equally, or at the same time, trying to expand your, enhance your internal capabilities. In the words of the former Uber CEO, who was, in a recent AI panel discussion, he said that companies with big data should have the curiosity and playfulness of a child and the rebelliousness of a teenager. So it gives you, it makes you question why not. Or conditionally, we're saying, this is related to this is related to that, and whatnot. But at the same time, it helps you to question why not. Why not trying to see a pattern between completely unrelated, sets of data. Maybe on the informal sector, before I come to the case in Ethiopia, I think with DPI, with the increasing use of this blocks and pieces of services, that informal sector, while it might still be informal for tax administration, it's increasingly becoming formal. Okay, they're getting digital IDs, not necessarily for tax administration, but for other purposes. They're using mobile money, and so that gives us an opportunity to understand them, to know them. In the case of Ethiopia, there hasn't been, let's say, a concerted effort, a deliberate effort to increase the taxpayer base apart from the mass registration that I explained earlier. However, recently, because of the expansion of the national IDs, I think the tax administration is understanding that, okay, I have no idea about, how many, let's say, brokers there are in the real estate, okay, and in property and asset transfer. Now they are having a clearer understanding how to get that data or where to get that data and how to use it to, of course, increase the taxpayer base. So increasing that taxpayer base, it all starts with understanding who our taxpayers are or who our potential taxpayers are. And this, digital identities can offer, of course, a good opportunity to that. Thank you.
Thank you very much. Moving on, also mindful of time, Kwame.
Yes, so quickly. Okay, so addressing the first question, whether TIN or the digital ID, So for us, I mean, how we look at this is we look at this as a journey, and where we're making steps, whether baby steps or we are moving like adults. But essentially, the key word here is seeing this as a data journey, right? So for us, and let me use a specific case, we have not entirely abandoned the what you call the legacy tin, or what we term as the initial tin for a taxpayer. As a matter of fact, if you come to our data platforms, we have a conversion table. So the conversion table basically aligns a tin or multiple tins to the digital ID, right? So that we are still able to trace other revenue footprints, right? So for us, we still leverage on the legacy data that we have. As to where we would let that go, I think it's a question of relevance, it's a question of context, and it's a question of where we have gotten to as a nation. Because as I said, our digital ID system is one, and in most cases, one that permeates the entire government. So that when we get to the point where we would entirely let that legacy data go, we will do. But essentially, we still leverage on that data. So the question is, I mean, for me, it depends on the context. Then moving on to the second one, how do you know which data is important, and how do you ascertain the accuracy of your data? I mean, for us, where we've started from, or when we started this, we embarked on a business stakeholder engagement, a very detailed business stakeholder engagement. So, for instance, if we're looking at, let's say, the pensions data, right, you have detailed engagement with the domestic tax business, right, to understand the various use cases for which you need that data. Now, before we embark on that, we share these business use cases with the third-party institution that we're exchanging data with. Yes, our initial one of our initial exchanges, right, were not based on use cases. So what we did was that we went back to the third party and said, you know what, share with us use cases, right, for the use of the data that you need from us, right? And then we will also share use cases, right, from a business perspective. And that is now translated into data requirements, right? And then that drives the sort of data points that we are looking to exchange, right? And then these APIs can now be enhanced, or they can be amended over time when there's a need for different data points. So for us, I mean, typically that's how we do it. I mean, and it's very important for you to look at your data requirements very well, and it should be linked to business requirements so that there is a need for the exchange you're embarking on, and saves cost and is more efficient. Then on the accuracy bit, yes, truthfully speaking, when you're embarking on this journey, there are a lot of data gaps. You would have a lot of data gaps because it's an intervention you are putting in. And as I said, over a journey, right, you would enhance your process as you go along. So for us, we more or less undertake more like a scored matching capability, right? So what we say is, okay, if I'm able to match based on some key, some primary key, right, then I would take that as a 100% accuracy, right? Then you lower the next one to, you can develop your criteria, right? Even for us, for the initial integration with the digital ID system, we had a scored matching capability where if you're able to match about 4 key data points, right, then you indicate that as a 100% score, right? Then it follows through in that order, right? And then you have obviously records that are not matched, but based on the benefit of the integration in other institutions, we are able to sometimes take benefit of that and then to enhance the data that we have. So just a typical use case, just quickly to wrap this up. we're embarking on a data cleansing, a mass data cleansing exercise, right? And we still had taxpayers that we could not validate their identity. And guess what? We're able to validate them from the third-party data that we had, right? So you realize that they matched exactly with the pensions institutions data that we have, right? And there are some that you still pick up and then able to match from other institutions' data. But how you handle this is how you score the criteria for your accuracy, right? And then how you now leverage on that to do your business. Is there, okay, for the informal sector?
How are we time-wise? Okay, we're good. Yeah, please go ahead. Yeah.
So for the informal sector, we have used varied ways of identifying taxpayers in the informal sector. And for me, and I know this discussion is something that has always been played along for several times, that the key thing is what is informal sector, right? Because what I've identified is that from the data that we have, our high net worth unit has been able to identify, in actual fact, since the inception of this initiative, we have quadrupled our identification of high net worth individuals, right? Which you would essentially call them as informal as well. Because from my understanding, because they were not showing in any data points, right? So using the driver's the vehicle licensing authority data, right? The high net worth unit is able to identify some individuals who have never filed or paid before, who own Lamborghinis and Maybachs and all of that, right? Through the, just so you know, we also establish exchanges with the government accountant general. So procurements are made, contracts are signed and awarded to sole proprietors and then companies with attached directors or own shareholding details, right? Now, what we do is that once we take that data, we match that data to our filing portal, taxpayer portal data, which is the filing and then payment. And then in most cases, you'd realize that they are not filing or paying, right? And based on the magnitude of the contracts these people are into, right, you're able to identify them and then engage them. And mostly when you engage them, they lead you to engage additional people. So they will tell you, I wasn't the one that benefited from this contract. Mr. ABCD are also part, so you cannot put the obligation only on me. And in most cases, the high net worth unit has been able to follow these leads in identifying additional people that are relating to certain huge transactions. So for me, these are, how you lead, and as Cinta indicated, right? If you are very playful with this as a child, right, you're able to, these footprints are able to lead you to other data points. Then last but not the least, we engage a lot now with this digital ID system with our customs data, or even though we are under the same umbrella as a revenue authority. There are instances where individuals and sole proprietors and companies undertake mass importations, right? And they are not in the tax net, right? We, by way of tax audits, we're able to match this data and give them to tax auditors who have profiled or are going to undertake some tax audits. And other related parties, we have agents in Ghana who essentially serve as clearing agents for imports for several organizations. And through that data, you have the consignee, you have the importer. Using the consignee, you're able to identify multiple individuals that are importing mass products that you can use to identify their activities and all of that. And based on even the descriptions of their importations, we're able to now leverage on this data. So, in several ways, we have several plans leveraging on financial data, the e-levy data, and all of that to cluster and identify based on spend pattern and then transactional patterns and all of that. But as I said, it's a journey, but that is how we are leveraging on this digital ID system to be able to permeate the informal sector, which, I mean, so far is, I mean, working very well.
Thanks, Kwame, also for highlighting the importance of what I would call actionable data. So if you have an entity importing a lot of goods and is just not reporting taxes, right? Obviously, you can take action on that. Whereas if you have Mary who turned 18 somewhere in a rural district, maybe not quite so actionable, right? So having a sense of what data will you actually be able to act upon and have that conversation with the third party to understand what the data means. I mean, we have all looked at other people's spreadsheets and not being able to figure out what it means. Tina, any reflections on the Ugandan side to these questions?
I'll address the question on how to ensure data quality from third parties. And the question of data quality is not unique to tax administration. But probably what I would say is that it's very important to understand the operations of the agency where you're getting this data from. In that you look at the data so that you're able to establish whether it aligns with the data sets within your agency. So validation checks are quite important in this process. An example I can give from the URA perspective is that for forced registrations, as indicated in Celeste's presentation, we utilized utility data, and the assumption we had was that whoever was paying for the utilities was, for example, if you're paying for water bills, you're the landlord. But we found that some tenants were captured within that process. And indeed, the quality of data at that point wasn't as good as we thought it was. So it's very important that you're able to identify the key data points and then ensure they are of quality through various verification and validation checks so that you're taking on data that is very useful to you. And another example I could give was cross-matching stamp duty data with the land registry because we wanted to identify the buyers of assets like land. And indeed, we were able to identify and expand our register in that kind of approach. So it's very important that you approach this cross-matching with carefully so that you're able to get quality data. Another thing that can really help is expanding partnerships. For the Uganda Revenue Authority, what we did is that we identified about 20 agencies that we wanted to partner with. But it requires investment in certain technologies in order to do that. So of recent, I think we are at about 70% of integrating with these agencies. And that answers the question on how to establish data that is important to you. But it's also important to build capacity around the data, to match the data so that you're able to obtain the useful insights that you would want to get out of it. In addressing the informal sector, what we have done as Uganda Revenue Authority is we've come up with sector-specific strategies. We've looked at the sectors at the GDP level and analyzed them and tried to compare their contribution to tax revenue. And in most cases, the gap that we see is brought about by the informal sector. So we are coming up with sector-specific strategies for those sectors that we deem to be having a high informality within them, and these include sectors like the retail sector, the manufacturing, where we have these cottage industries, the financial sector, where we have the money lenders. So yes, we are trying as much as possible to tap into that. But also, a targeted approach is very important. Like the moderator said, that most times we assume that the informal sector is composed of SMEs, but there are also large operators in there, including high net worth individuals, so it's very important to segment and critically address. And then using data, I think I can't overemphasize the importance of data analytics and tapping into the informal sector. Thank you.
Thanks. Celeste, I would like to put you a little bit on the spot. Are there things coming out of this conversation that you and ICDD will be looking into from the research side? And think a little bit about that, and then I'll make just a few concluding remarks based on the panel's intervention. So what we did in my former unit is we created a sandbox. So we got a lot of kind of dirty data, if you like, and not so high quality data, and then put it in a separate database and lifted information into the production system gradually. So we didn't kind of pollute our higher quality production system with that kind of data. So depending on what data you're getting, that may be what you want to do in some cases. I think the thing you mentioned, Tina, about the sectoral approach is really key, because the data reflects a reality, and if we don't have any views on the reality, we don't know what we're doing. So for example, if I'm getting utility information, then depending on the country, it may be the owner paying the utility bill, it may be somebody renting, it may be the family member, it may be somebody squatting. We need to understand what is that identity that is incurring that utility bill, right? And once we have that understanding, we can move on. On the informal sector, I think there's a couple of things coming up here. One is, we didn't really talk about it, but there's also an issue, is our taxation system fit for purpose, right? So if we have a small merchant somewhere, are we providing the right kind of format for working with them? Or are we coming with our existing business model, right? So I think we need to think about that. And also I like, Tina, the sectoral approach, right? So if we talk about informal sector and we talk about bus and cab drivers, it's very different from small merchants, which is very different from farmers, which is very different from, and so forth, right? So having a more sectoral, more targeted approach, then we can also discuss who do we want to bring in. So if we have somebody running his own cab, do we want to bring that guy in? If we have somebody running 3 buses, well, probably so, right? So thinking about what the results look like. But let me stop here and then hand it over to you, Celeste, and see if there's something that piqued your interest, that you're thinking about, again, without committing you might follow up on the ICT side.
Yes, thank you, Andres. So as you might have learned at the beginning of the conference, we have just received a new grant, which is which we call the DPI grant, which is specifically meant to fund research on DPI and tax administration. And within that grant, I think we're going to touch on many of the things that have been discussed during this panel and also in other sessions. I personally will really like to, for example, study how to improve the compliance of taxpayers that have just been registered. So actually, more than improving the compliance, how to, engage them in the compliance journey, and what are the best tactics and nudges to do that, which also includes, I think, something that is very important, which is taxpayer education. So before asking taxpayers to to respect their tax liability, it's important also to guarantee that they have some kind of tax education and they're aware of what what their tax liabilities are, and so on, and what are their duties as taxpayers. But there is also, I think, there's going to be quite a lot of focus on how to improve compliance of high net worth individuals and how the different high net worth individuals unit, and generally speaking also revenue authorities who don't have that kind of unit, how are going to use the data that comes like in the context of data exchange for compliance of these category of taxpayers. And lastly, yeah, I mean, we are going to touch, like, the program is going to develop around different themes, and there's also the theme of data exchange at the international level. So how does that help revenue collection, again, but from like an international tax perspective. So yeah, we are actually, I think, going to touch on many of these things. Thank you.
Thank you very much, Celeste, and please join me in thanking her and the panelists for today's session.
Thank you to our moderator for this last session, and also to our panelists. I think by now, if you don't get that it's becoming a global village really, really quickly, and that it's pretty much a human movement, then maybe you should be thinking again. Because for me, when I think about the conjunction between digital ID systems and taxpayer registration and the possibilities therein, my mind is blown. We're due to have our 15 minutes break, coffee break. So if we can please be back here by 11:45, so that is 11:45. Thank you. Enjoy your coffee. and what opportunities those might have with regards to tax compliance. The session will consist of a policy-oriented discussion on the potential of digital payment systems to strengthen tax administrations, namely through more formal transactions and access to third-party payment data. As cashless payments like mobile money gain momentum in African economies, tax administrations could leverage such solutions to foster formalization and better enforce compliance. This to me brings to mind EBM stuff as well. But yeah, I live in this world. Our scene setter for this session will be Fabrizio Santoro, who is a research fellow from ICTD. And our panelists then will be Fabrizio Santoro again, Isaac Amoako, who is acting head transformation officer at the Ghana Revenue Authority, and Lutando Mvovo, head of international tax at Vodacom. Our moderator will be Dimitri Konsovic, who is coming from the German Agency for International Cooperation. Fabrizio, welcome to the panelists. If you could please take a seat in the front. Thank you.
All right. Welcome back, everyone. I'm happy to set the scene for this quite interesting panel today. It's all about digital payments and the opportunities for tax administrations. As the MC was saying, digital merchant payments, digital payments comes with huge potential to strengthen tax administrations in terms of easing record keeping and filing for taxes, in terms of generating a digital paper trail, in terms of spurring formalization of economic transactions and of business formalizations. It's actually also quite similar, conceptually to our work on electronic billing machines. So as the MC was saying, there are some comparisons there. So first off, yes. Right. Let's start with the definitions, because I think there was a bit of confusion. When we talk about digital payments, we're not talking about payments of taxes digitally, but we're talking about, as the World Bank would put it, retail payments or merchant payments, which are payments associated with the purchase of goods and services from a business, irrespective of the size, where the payer is a consumer and the payee is a business. So it's a transaction at the retail level between firms, traders, and client customers. What about digital payment systems? Instant, inclusive digital payment systems, which is actually also a core building block of the DPI approach. According to the India's G20 presidency, digital payment systems are easy and instant transfer of money between people, business, and governments. In Rwanda, eCash from RSwitch is a key example of such solutions. Again, digital payments is a core building block of the DPI stack. I want to show you some stylized facts first. So this comes from the Global Findex from 2021-2022, so it's a bit outdated already, and it shows the percentage in the population, 15 and above, that made a digital merchant payments in store or online. And unsurprisingly, we always see the outliers there in terms of South Africa and Kenya, Zimbabwe as well, Namibia, then Ghana doing quite well. There's lots of heterogeneity. Our research somehow complements this mapping, right? And again, I'm pretty sure that in the last 2 or 3 years, the adoption significantly improved. Another map I want to show you, it comes from the recent African and IFC report on instant payment system status in Africa. This is extremely updated. It came out last month. It's all about mapping which countries have a live they call it IPS, the instant payment systems, and in which countries is still in development. As you can see, Rwanda, for instance, Ghana, South Africa, of course, Kenya, Tanzania, Uganda, all have, Ethiopia, all have enabled platforms for instant and inclusive payment systems. Many other countries are still are in the process of introducing it. So it's quite interesting trend there. All right, at this point, I think I will summarize what we learned in the last 3 or 4 years of Digitax work. This comes from a quite interesting combination of countries and perspectives. It's a team of a dozen international researchers, for which I'm very proud. Some of this work is also there in the posters if you are interested. We really try to understand what is the potential of digital payments in African economies for tax administrations. The first finding is about mapping adoption. So this comes from survey work that we did in 5 countries, Tanzania, Rwanda, Uganda, Ghana, and Burkina Faso. We surveyed 6,000 businesses, 6,000 firms, trying to understand patterns of adoption and implications on tax perceptions and tax behavior, right? So let's start with the mapping. This also links to the global Findex map that I showed you before. The first key finding is that cash is still prominent. This comes from Rwanda. This is the preference modes of merchants. 88% of the merchants in the sample, 1,100 merchants in Rwanda, still use cash. Momo Pay and Momo Personal are used by half of the population. So mobile money, which is a key, of course, mode of digital payments, is common but is not universal. And this trend is consistent across countries. So if we go to Ghana, again, almost the totality of the sample uses cash, merchants use cash, and Momo Personal and Momo Pay are a bit less frequent. Momo Pay is the merchant-specific mobile money service designed by MTN, right? And Tanzania as well, the vast majority uses cash, and mobile money is even less relevant. I think in Uganda things are, and in Burkina Faso again, cash is quite relevant. Mobile money is more prevalent than in Rwanda and Tanzania. And in Uganda, same story. Bank transfers are quite common here, which is a bit of an outlier compared to the other countries. But again, cash remains king and is used in parallel with digital merchant payments, often strategically. What about the reasons for not using Momo for payments by merchants? This is Rwanda. We also have similar findings from other countries. Happy to share the results. The key barrier is about charges and fees. So the key reasons why merchants say, I won't use Momo is because of perceptions or awareness around fees and charges, right? Another interesting one is that clients prefer cash. So this again around preference for trading partners and the persistence of cash in the economy. In terms of the reasons for adoption, which are not here, are those that I mentioned before: the ease of keeping track of sales, and also preferences from suppliers and clients. So it's quite dependent on what's happening throughout the supply chain. Cash is also used to transact large amounts. So another key finding is at the intensive margin, when we measure the actual amounts transacted, as you can see from these countries, Burkina Faso, Rwanda, Tanzania, the continued line for cash in terms of amounts is quite similar to the line of mobile money, if not bigger. Move to the right. It means that larger amounts are transacted in cash, even larger than what's happening with digital payments. So there are implications here, of course, for tax monitoring and enforcement if so much cash is used for larger amounts. Again, on adoption, which is a key topic here of our research. Adoptions of digital merchant payments depends on a range of factors, such as usage in the supply chain, as I said, interesting network effects there, IT readiness and access to internet or bank accounts by merchants, knowledge and awareness around the tax systems and the mobile money solutions. Financial inclusions, yes, having a bank account, as I said. Size is a key predictor of adoption. And it's interesting, again, linking to electronic billing machines and electronic filing, any tax digital service, we find the same digital divide here between users and non-users. This pattern is very similar if you analyze electronic billing machines adoption or electronic e-tax adoptions, right? So it was quite interesting to find this consistency. Another finding I want to show you is around fiscal incentives. So governments can do, can influence adoption by fiscal measures. The Treasury and finance ministries can play a significant role there. We did some work which we plan to continue in the next 3 or 4 years. For instance, in Rwanda, the telcos during the pandemic waived the fee on merchant payments for 18 months to spur adoption. And we were very lucky to be there and analyzing patterns of adoptions. And we showed that this waiver of the fee significantly spurred mobile pay uptake. When the fees is reintroduced 18 months later, adoption of digital payments goes down a bit, but not below the initial pre-pandemic level. So even when you reintroduce a fee, which in the case of Rwanda was a bit lower, was half of it, of the initial one, adoption still remained quite high. In Ghana, the e-levy, and I'm happy that Isaac is here, the e-levy, the mobile money tax, came with an exemption, a fiscal exemption for merchant payments. So we try to understand the role there of this exemption. We are somehow confident that it pushed merchants towards using MomoPay, but cash still remained there. There was no switching of methods. Cash was still being used. Customers start preferring shopping with MomoPay, which now was exempted. And in terms of perceptions, we surveyed these merchants, and they were quite happy. So benefiting from an exemption on payments actually improves your perceptions of the government and on the tax system, on the levy policy as well. Last finding, it's about behaviors, taxpayers' behaviors after adoption. The key finding is that digital merchant payment users strategically file for VAT after adoption, offsetting higher sales with higher inputs, and quickly reverting to pre-adoption sales levels. So this comes from administrative data from RRA, right? And we compare the adoption time by merchants with their filing behavior for VAT after. And what we see is that turnover goes up, taxable sales go up, but also inputs go up. Clear offsetting response that we documented also when it comes to electronic fiscal machines in Ethiopia, for instance, in other contexts. At the end of the day, nothing much changes for merchants in terms of VAT remitted. All right, so in terms of concluding thoughts, which I think can inform the panel discussion. Okay, sorry. Oh. Well, there was a concluding slide which was all about further avenues for policy research, understanding patterns of adoptions, and understanding how we can incentivize merchants, how to build value, create value for merchants, understanding the potential of data from telcos, from digital merchant payments, how can be unlocked by governments, again, on capacity of revenue authorities to make best use of such data. Okay. We really hope to do more work on this, so happy to chat more with anyone who's interested, and thank you.
Thank you very much, Fabrizio, and please take a seat. So, welcome to the session on digital payments and what opportunity is live for tax compliance. First of all, let's address the elephant in the room. We are deeply sorry to present you a manual. It is due to quite a number of last-minute dropouts that even I had to stand in as has to serve as a stand-in. But nonetheless, I hope we will have a thoughtful discussion with the representatives from different industries and sectors, and we are going to discuss the issue of mobile digital payments. So yesterday's session on digital inclusion left me with some thoughts hanging. So it was Chennai who mentioned that one should think about unintended consequences. Unintended consequences of policy choices and the way technologies are being set up. In the way yesterday's pre-session when Lotando and when we discussed what to discuss today, I offer them to first come up with a softball question, something to start and to have an easy win with the audience. But we decided to go straight into the hard topic and to think and discuss unintended consequences. So let's dive straight into it and address the issue. How has the taxation of mobile money led to adverse effects on financial inclusion? And I would be grateful to you if each one of you, from your respective perspective of a global telco, of a revenue authority, and academia, could offer your particular insights and point of view on this question.
Thank you, Dimitri. Good morning, everyone. Thank you to the ICTD for the second invitation this year. And thank you to the Rwanda Revenue Authority for co-hosting this event. I think it is important to discuss issues of this nature because they have an impact on the people on the ground. Our view is, or my view is that the tax plays a big role in slowing down the growth of mobile money and consequently the growth of financial inclusion and digital inclusion. So if you look at the history and the development of mobile money, starting from 2007 in Kenya, the growth was phenomenal in the first 5 years. And that is why, as a result, after Kenya implemented it, Tanzania, Uganda, and other East African countries followed, and West Africa followed suit, and the growth was phenomenal. But then that same growth, if you look at the years where the growth took place, it was around the financial downturn, global downturn, economic crisis, and it became attractive, that's my view, to the tax policymakers as a form of revenue raiser, and they started introducing excise taxes. So it started in Kenya, not surprisingly, where there was an excise tax that was introduced on mobile money, and other East African countries followed suit. But not all of them, because Rwanda did not introduce a mobile money tax. And I think that's why we started seeing a slowdown in the growth. So if you look at the example of taxes that are imposed, Kenya currently imposes an excise tax on mobile money at the rate of 15% on transaction fees. Tanzania has a 10% excise tax on transaction fees, on the withdrawal and the transfer fees. Over and above that, there is a mobile money levy on transactional fees, mobile money transactional fees. And again, if you look at Tanzania, it is a very good example of how tax slowed down the growth of mobile money. So if in 2021, so Tanzania had, from 2013 to about 2021, they had an excise tax. That in the beginning slowed down growth, but over time, then people got used to it. But then in 2021, the government of Tanzania introduced a mobile money levy, and that coincided with the COVID lockdown restrictions. So the mobile money levy was introduced on the 1st of July, 2021. Between the 1st of July and the 1st of September, 2021, we saw a reduction in the use of mobile money by about 27%. And we went to government and say, look, this is the negative impact this is having on the use of mobile money. And government took note of that, and they said, we're going to reduce the threshold of mobile money levy by 30%. That still did not make a big difference, because in terms of numbers, we saw between that period, September, when there was a reduction of 30% on the mobile money levy threshold, to December, we lost PESA alone. PESA Ltd lost about 1.3 million users or subscribers of mobile money. And that again showed the negative impact. And fortunately, government took note of that. They took note of that. And as a result, at the end of in June 2022, they decided to amend the mobile money levy, and they decided that on the transfer fees, on the transfer of money, they will not apply mobile money levy, but they will only apply it on the withdrawal, and that sort of changed the behavior. We started seeing again an increase in the use of mobile money. We saw it in Ghana as well. When Ghana introduced the mobile money levy, there was a public uproar, and the use, it had an impact on the mobile money use in Ghana. But I'm not going to dwell much on that. I'll leave that to my colleague Isaac to address. So if I sort of prepared an example of the impact of mobile money. So again, I decided to take Tanzania. So if I transfer 50,000 shillings to my relative, so let's assume I'm in Dar es Salaam and I'm transferring 50,000 shillings to my relative who's in Arusha. And so on that 50,000, there will be transfer fees. On the transfer fees, the tax authority will apply excise tax of 10% on the fees plus VAT on the same fees, right? And when my relative withdraws the money in Arusha, there will be an excise tax on the withdrawal. There will be fees on the withdrawal, sorry. And that will also include tax on the withdrawal. And remember, they also have mobile money agents who will also charge a commission on that. And the mobile money agent will also be subject to a withholding tax of 10% on the commission they charge on the same transaction. So you can see the impact that tax has on just a single transaction. And that definitely then will drive away people from using mobile money to going back to using cash. I'll stop here for now.
Thank you very much. Over to you, Isaac.
Thank you very much. I must also thank ICTD for inviting me for this conference, and also thank my colleagues in RAA for organizing this with ICTD. So what is the adverse effect of imposing the tax on mobile money transfer? Prior to the rollout of the mobile money, the e-levy in Ghana, we saw a dip in the transfer values that were reported by the central bank. So that shows that people felt that this was going to drastically affect mobile money transfers in Ghana. But then when we went live May 2022, we saw that it started picking up. And up to date, it's not gone down. Last year, just this year, the Bank of Ghana has come out with the latest rates, and it shows that it still has gone up. So then what is the secret behind Ghana's mobile money still rising despite the fact that the e-levy exists? I must also say that there was a lot of opposition to the introduction of the e-levy. Ibani, Ghana did a survey. Over 80% of Ghanaians are not in favor of the e-levy. No wonder the two political parties, the current government and the opposition, have all promised that in the next administration they are going to abolish the e-levy. But then, from where we sit as Revenue Authority, we can attribute the fact that the e-levy is still growing to a number of factors. And I think it has to do with the number of exemptions that were granted under the policy. There is a 100 Ghana exemption if it's a mobile money transfer a day. We also have 20,000 Ghana cedis if the transaction happens to be a bank transfer. That is moving from your bank account to another bank account. You have a 20,000 threshold, which is a little over $1,000. That also seems to have done the trick. Then the segment that would have been affected the most, that's the informal sector, those who do smaller transactions on a number of times. We realize that because if an agent, a Momo agent, is doing the transfer, the levy doesn't apply. People stop doing peer-to-peer transfer and rather resorted to using the agents to do the transfer. So by using an agent to do the transfer, they don't get to pay the e-levy. And that could also account for the reason why we are still having the volumes and the values still increasing. Even though we've met with the telcos in Ghana and they are angry that peer-to-peer transactions have dipped, and that is where they make their money. That is the golden egg for the telcos, that if customers are transferring directly from their account to another account, then they get their charges. But then because of the e-levy, people have stopped and they are rather resorting to the use of the agent. And that, I must admit, is an adverse effect, especially for the telcos. We also realize that as an opportunity, the Ghana card that is linked to the accounts, by insisting that before we grant you some of the exemptions under the e-levy, we have an exemption that if you transfer between accounts that you own yourself, that's to yourself either at the telco level or at the bank level, the e-levy does not apply. But to qualify, those accounts have to be attached to your identity, which is your Ghana card. And that goes for even corporate entities. If a corporate entity is operating a bank account and that bank account has not been linked to its corporate TIN, then we don't grant the exemption. So we realize that despite the fact that our laws as far back as 2016 had required that the banks create bank accounts by linking the account with the taxpayer identification number, on the ground they hadn't done that. On their electronic portals, the tax identification numbers did not exist. So when we asked them to send those data to us, it came without the taxpayer identification numbers. Therefore, even though a corporate account is exempt, they ended up being charged the e-levy. So then that started forcing the banks to comply with this directive that had been in existence before the e-levy. And I think that is also why we are having the values go up. It's now giving us a digital opportunity to enforce a provision in our law that every bank account, financial account, should have a taxpayer identification number, and it wasn't being adhered to, but for the e-levy platform. Another opportunity is that the Revenue Authority now has live data of all financial transactions in Ghana. Whenever you make any transfer, we get to see it, and we see it live. And this is a golden data that we currently have. I am praying that the next government will recognize that this is a golden data, and even if they do away with the e-levy, we find a way of still gathering this data and use for compliance in the future. I would end here for now. Thank you.
Thank you very much. And over to you, Fabrizio.
Yes, thanks, Dimitri. Yeah, it's a very important question. There is lots to say there. We did a full conference early this year in Ghana on this specific topic. In ICT, there is a specific team been working on impacts of mobile money taxation. We summarized the findings on a policy brief. So, I mean, the results are still quite mixed in terms that impacts depends on how the tax is actually structured. If it's on amounts, if it's on the fees set by telcos, or if it's on the turnover of telcos themselves. It depends on the trajectory of mobile money adoption, how widespread it is, at which stage adoption is in the population, as I was saying. But I'll be happy to take your questions from a different perspective, which is that, again, on fiscal incentives, which often comes included in this mobile money tax packages, as in Ghana, for instance. And we have been doing some interesting work, I think, on this topic, fiscal incentives for merchant payments, for registered merchant payments. What is their effectiveness in terms of spurring digital transactions in the economy and formalization of businesses? We mapped key strategies from all around the world, and with a work led by my colleague Lucia Rosella at the back. So happy to talk more about this. Again, the effectiveness is quite mixed and context specific in terms of success stories. There is definitely that of South Korea. There's a World Bank paper article on the South Korea program on incentivizing electronic payments, showing that since 1999. Significant exemptions for wage earners claiming expenses made through electronic means boosted significantly revenues, and for personal income tax, the total net revenue gain was about $1.3 billion. South Korea since then moved to a different trajectory where digital merchant payments are widespread. Again, evidence is quite mixed. In other contexts, mostly from South America, the effectiveness of such fiscal incentives was mixed, such as in Uruguay, for instance, where providing POS rental, the waiver of POS rental fees, spurred, encouraged usage just the intensive level, and it didn't push an increase of payments adoptions at the extensive margin. Another interesting case study, I think, is around demonetization, which is a way of making cash more expensive. Probably the most successful case study comes from India, where in 2016, I think 85% of its currency in high bills notes was made illegal. This was a dramatic, brutal sort of change that, with lots of protests, but in the long term, researchers show how this pushed normal people and merchants to adopt digital payments, and so it was quite effective also in raising revenues. As I said, again, we did some work in Africa, and the case of Rwanda is quite interesting. It's not a fiscal incentive; it's a removal of a telco's fee, MPN fees, which, to me, by the perspective of merchants, won't change much. I mean, it's always a cost. So we definitely learned some lessons from this specific case, from this specific private sector solution, lessons for fiscal policies as well. Removing a fee on Momo Pay during the pandemic significantly pushed merchants to adopt it. Even when you reintroduce it 18 months later, as I said, adoption still remains high. In Ghana as well, the exemption on the merchant payments was quite effective. So it's still a nascent sort of field for research, and as I said, we're happy to do more work, especially in Africa, as there is very little evidence on this. Thank you.
Thank you very much for the first round of questions and answers. So now second round with individual questions to each one of you before we then head straight into the question and answer session, because I'm pretty sure the audience, you all have your experiences and insights to share and discuss. And now to the individual questions. So, Lutando, how can mobile money be used to encourage tax compliance? And are there actually even examples where mobile money is already being used for making tax payments?
Thank you, Dimitri. So when you look at the number of registered users in sub-Saharan Africa and the growth, I have no doubt you'd agree with me that this is the most established and the fastest growing financial technology in Africa specifically. And as we always say, data is gold. I think there's an opportunity here. So I looked at the numbers and the growth. So in 2021, the number of registered mobile money accounts in sub-Saharan Africa was around 621 million, with 184 million active accounts. And I looked again at it per region. So East Africa had about 296 million registered accounts, of which 102 of which were active accounts. West Africa was 237 million registered accounts, and 58 million were active accounts. And Central Africa, it was 60 million, Southern Africa, 13 million, and Northern Africa, 15 million. And when you look at the transactions that were used, the transaction values, they were around 701 billion US dollars. When you look at the current position now, the number of registered accounts is over 834 million accounts. So you see there's a more than 200 million growth in the number of registered accounts, and that represents 48% growth in terms of the increase. And the number of active accounts was around 234 million. And transaction values were over 102 trillion US dollars. So there's a big jump even in transaction value. And when we look at this, you can see that there's an opportunity for data and for this data to be used productively to increase and encourage tax compliance. There are countries that have tried to use mobile money for the purposes of tax compliance, but the uptake hasn't been much. And we have our views on this, that tax and fees could be a contributing factor in attracting, small businesses and individuals from using mobile money to pay their taxes. But KRA, in Kenya, where the mobile money this invention started, I think they are far ahead and they are leading the way, and I think they are a good example to look at. You can pay your taxes using M-Pesa. So, you get that when you go to the KRA website, you will find, guidance on how to use your M-Pesa account to pay your taxes. And my understanding to date is that that has been a success. But in other countries that also have M-Pesa, it hasn't been a success. And how can revenue authorities and telcos in particular work together to ensure that the use of mobile money to pay taxes is increased and is encouraged? It starts with taxes. So if authorities, it starts with fees, sorry. So if it could be agreed that when you pay your taxes, you are not subject to fee, you won't be subjected to fees. So if I use my M-Pesa to pay money to the revenue authority or to pay for government services, if the fees are either lowered or they are removed completely, for me that will be the first enticement for mobile money users to use the instrument that is used widely in sub-Saharan Africa to pay their taxes, especially your small businesses and individuals. And secondly would be the taxes. So if the revenue authorities say, if you use, you transfer money to the revenue authorities account to pay your taxes, there won't be taxes, there won't be excise taxes, there won't be a mobile money levy. I think that will also increase the use of mobile money to pay taxes. The advantage or the benefit for the revenue authority is that it provides visibility, and you can see, what the accounts are used for, and that could also lead to the exchange of information. So if I can slightly move away from mobile account to use an example of how financial institutions and third parties collaborate with the revenue authority and the successes that is achieved through that collaboration. So in South Africa, SARS 2 years ago introduced auto assessment. Now, in the past, way before they introduced auto assessment, if you are filing your tax return, you needed to collect information from the bank, get a tax certificate from the bank, get a tax certificate from your medical aid, from your pension fund, from your insurance. But that happens automatically. So on the 1st of July, when the tax season starts, you open your tax return, you go to your e-filing, or you go to your SARS app on your phone, you open it, you will find the information from the bank. Your tax certificate is uploaded by the bank already. The insurance company where you invest your funds or retirement annuity has uploaded your tax certificate. The medical aid has uploaded your tax certificate. Your pension fund has done the same. So if you receive dividends and you pay dividends tax, the information, you will find it there. And when they introduced auto assessment, people were complaining about the inaccuracy of the information, and SARS listened and corrected that. But now, on the 1st of July, when the tax season starts, you go to the app or to the e-filing. You find that information. All you have to do is to reconcile that information with the one that you have. If you agree with everything, all you do is just to press submit. It doesn't take even 10 minutes to do that. That could be done through the mobile app, where the revenue authority would receive information from financial institutions, from the pension fund, in the case of the employees, and from the telco, if there's information that is required from the telco. And all the revenue authority would do would be to provide that information to the taxpayer through mobile money app, and the taxpayer would reconcile the information that she finds there with the information that he or she has at hand. And if she's agreeable to that, then she can send the information. Thank you.
Thank you very much. So, and with these words and ideas, over to you, Isaac.
Thank you.
What do you think, what are the opportunities abound for revenue authorities when it comes to having access to digital payment data?
Thank you very much. For Ghana, we also, as part of the e-levy, there was the exemption that if you are using your Momo to pay taxes, not only taxes, fees, and charges, then the levy doesn't apply. So in Ghana today, not only the revenue authority, but other government agencies who are on the government payment gateway or payment to these institutions do not even attract the telco charges. It is zero charge, both the levy and the telco charge, and that also seems to have helped. And as a result of this, we've managed to get a payment channel for our small taxpayers, those we call the informal sector. We have a tax called vehicle income tax, mostly paid by taxi drivers and cab drivers. And we've managed to allow them to pay using the Momo, and there is no charge. We are yet to do a similar one for another segment of our taxpayers. That is the tax stamp presumptive taxation. They pay very, very minor taxes. So that opportunity has really been used in Ghana. The other thing with the data that we've collected, we did a DEX audit of the data that has come on the e-levy platform and compared it with data that the financial institutions have sent to the central bank. So we wrote to the central bank. They were good enough to give us a month's data they've received. And when we did a comparison, we realized that only 10% of the data they've shared to the central bank has been put on our platform. So we quickly realized that the telcos were not reporting all the transactions onto the platform. So only 10% were being reported. We quickly did an audit and raised an assessment to the telcos that we've picked your data at the central bank, this is how much, and this is the data you've reported on our platform. The variance, we don't know where it is. So you owe us this amount. And it was that huge amount. So quickly, they all started realigning and started sending the data onto the e-levy platform. So we moved from 10%, now we've done more than 50%. So this is a great opportunity for the Revenue Authority to have visibility. If there is a third-party data you can get with other state institutions, then you can validate whether the players are really sending you the data, because the primary data, you, the Revenue Authority, would not be privy to the primary data until it is reported on your platform or until a taxpayer comes and complains that I've been charged a service that I'm not supposed to charge, or a transaction that ordinarily should attract e-levy but was not charged the e-levy. Then we get the opportunity to know that some of these players are not compliant, and that allows us to do that. We also had some barriers. Some of the telcos were raising concern that what legal power do we have to ask them to send financial data to the Revenue Authority. We went back to look at the Revenue Administration Act, and we realized that the way it was crafted, it didn't capture exactly the design that we have. In the Revenue Administration Act, it just gives the Revenue Authority the power to ask for any information. But it looks like that is on ad hoc basis. As and when you need, then you go and ask for that data. It didn't establish a continuous data exchange between the telcos or the banks and the Revenue Authority. So quickly we saw that there was a loophole. We did an amendment to the Revenue Administration Act and put a provision in the Revenue Administration Act that the Commissioner General has the power to ask you to connect your digital platform to any platform that the Revenue Authority is running. And that seems to have removed that legal barrier. And the data is still growing, and there are more opportunities that we can use to even identify high net worth individuals. That is our target, that we can use the pattern that we see in this data to raise more revenue. Thank you.
Thank you very much. Listening to you, the old saying, which dates back supposedly to the French finance minister Colbert, comes to my mind. The art of taxation is comparable with plucking the goose as to obtaining the largest amount of feathers without any hissing of the goose. Admittedly, Colbert was the Minister of Finance in France right before the French Revolution. So, Fabrizio, in this regard, what are the behavioral responses of taxpayers after the adoption of digital payments, and does the taxation of mobile payments drive users back into the informal sector?
Thanks. Yes. So when it comes to behavioral responses of taxpayers, in ACD we've been looking again at both the payment of taxes digitally and, of course, the impacts of adopting cashless transactions in an economy, right? And on payment of taxes, results are consistently positive. We did an assessment in Rwanda which is called M-Declaration, where you can, for presumptive taxpayers, right, where you can declare and pay the taxes directly through your feature phone and pay through mobile money. That was extremely appreciated by taxpayers because it definitely facilitated. You don't even have to have access to internet, for instance, like, as it works on more money. In Eswatini, we're doing a similar study comparing digital payments of taxes with cash payments. And in the country, since a couple of years now, there has been a mandate of using digital payments only, and results are consistently positive. Where I think more caution is needed is when it comes to, again, as I said before, perverse responses by merchants, by traders in an economy after adopting digital payments. It's still, I mean, as we show in the case of Rwanda, there was a sort of offsetting response in terms of VAT filing, right? So after adoption, taxpayers would report higher sales, which attracts higher VAT, but they also would report higher inputs. So at the end of the day, the final liability is unchanged. And this offsetting response is so common, actually, in the literature. In previous studies in Ethiopia, we documented a similar finding, even in the US, when it comes to impacts of credit card payments and reporting behavior. There is a very similar pattern. So I think this is, of course, due to the fact that taxpayers, users of merchant payments, are not scared by the fact that they are transacting digitally, and they don't believe probably that the tax administration has the access to the data, to their data, which is often the case. Often tax administrations have no access to digital payments data, or even if they do, probably they believe that it's not such a big deal, that there is not enough capacity within tax administration to make the best use of that digital payments data. So, and again, this goes across all different technologies, electronic billing machines, electronic filing of taxes. This constant offsetting of higher turnover, higher sales with, say, higher inputs or less verifiable, on less verifiable margins. So here, I mean, there are of course, questions around enforcement capacity, monitoring capacity of tax administrations of governments when a new technology is introduced, and taxpayer perceptions of the actual threat. Yeah, in other contexts, like again, probably in Kenya, right? When the KRA announced that they will start using data from MomoPay, from the merchant payment service, there was an immediate backlash in terms of merchants just stopping using the tool, reverting back to cash and informal transaction. It's a very tricky sort of balance there. In my view, I mean, the only solution is again to create value for users, for taxpayers when using the digital payments. It's not just about being visible to the tax authority, but there are many other benefits. I want to just stress again the case of India, which, when it comes to DPIs, is probably the most successful story. In India, since a few years now, there is a specific DPI, a framework of applications called OCEN, Open Credit Enablement Network, OCEN, which is a DPI solution, which basically makes use of digital merchant payments data, digital payments data, for the benefits of bank customers, of clients in the financial sector. It used that data to build a score and streamline, the lending to eligible active, users. So, that solution was extremely effective in India in spurring, in indicating that there is value in this data, in adopting digital solutions, in generating data from digital transactions, because not just the tax administrations would have access to it, but also government as a whole, financial sector as well, for other purposes. Thank you.
Thank you very much, gentlemen. And now over to you, the audience. Which burning questions, remarks do you have? So let's collect 3 at a time, and then the second round.
Thank you. I think my question is directed to a colleague from Ghana. I think you've talked about the incentivization for the end users or the taxpayers, for them to be able to, because there are various exemptions that are given. Are there any exemptions that have also been, or any incentives that have been, are there for the payment service providers and the telcos and the like? Maybe I'd love to hear maybe a bit more about that. Thank you.
Thank you for the beautiful presentations and the discussion. Listening to Ghana, it's very interesting, and you can see it is attracting a lot of interest from the Kenyan participants. Now, you mentioned something about utilizing data from the central bank, and that made me itch to go back to my country and to do something similar. So, but the issue that I really wanted to hear from you a little bit more in terms of the usage of the mobile money is in relation to the informal sector. Because one of the panelists mentioned that the mobile money has created a great opportunity and is a success story for Kenya. But when it comes to that segment, what we've seen is an issue of there's the option within mobile money of withdraw cash. Now, somebody would go and do a business transaction, and when it comes to payment, the seller tells you just withdraw cash and go away. So that means there's no record, because it's like you've gone and withdrawn an amount from your own account. Now, when you withdraw that cash, in the back end of the seller, that they have, they know how they link up with the agent. So that results in a very serious leakage. And perhaps that even explains why initially when you talk of transaction fees being high and people drop off, then when they realize that there is a way out, the issues about transaction fees no longer become an issue. They continue trading and utilize more of the withdraw cash option. So what I wanted to hear is whether Ghana, you experienced that kind of challenge. But then the other issue is about how fast you are able to get to the level of monitoring on a real time all transactions, all mobile transactions, because as you've heard, Kenya was a trailblazer with M-Pesa, but up to now, we've not yet been able to be monitoring on a daily basis all the transactions of M-Pesa. In fact, if we need any data, we have to request for it on a case-by-case basis, because we are not yet there because of legal issues and other hurdles that arise along the way. Thank you.
Seems like Isaac is getting a lot of questions. So sorry, but you'll get another one. I was curious to hear more about the amendment to the tax administration law that you made to allow the access of transaction data in real time. There's a lot of countries in which the Commissioner General has the legal power to access bank transaction data or mobile money transaction data, but then in practice, the application of this power is extremely complex. So I wanted to know whether you could share a bit more something around the politics of making that amendment, and how it was possible to ensure that that legal power could also be put, in practice applied. And then a curiosity whether you think that there's a future in which you'll be able to get data not just about digital payment transaction, but like bank-to-bank transaction between private accounts, because, especially for identification of HMYs or for identification of potential economic activities that give rise to a tax liability, like seeing bank-to-bank transactions seems quite interesting. Thank you very much.
So, Isaac, you're the most popular one.
Okay, thank you very much. Let me start with whether there's incentive for the payment service providers when it comes to the incentives that were granted under the e-levy. Yes, the incentive is called principal master agent transfer. What that exemption meant is that if any of the charging entities are making a transfer, it is not taxable. So the entity that's the telco company or the bank or the specialized deposit taking institution, the entity itself, your transfers are also exempt, just like the other exemptions that were granted. So there is an exemption for them. Then I'll go to the issue of the central bank. When we're able to get data, my colleague says in Kenya, they have to do on request. It is also on request. But then I think in Ghana, there was a history. When we introduced the communication service tax, we brought in a private partner to help us monitor if the communication service tax is being correctly reported to the Revenue Authority. And we couldn't do that on our own. So we brought in these private vendors. Then there was a pushback. The telcos fought that for privacy and security concerns, they were not going to allow that monitoring to take place. So that back and forth brought about a revision of the communication service tax, where we now put into the law of the communication service tax that the revenue authority has the power to connect physically to your nodes. So therefore, you can't come and say that for privacy concerns, they can't connect. And that opened the gate for us. So when we were making the amendment, which I'll come to Giovanni's question, we went to the text that was used in the communication service tax and more or less imported that text into the Revenue Administration Act. Because the politics have been fought during communication service tax, I believe it didn't return back when we pushed it into the Revenue Administration Act. So that is what helped the Ghana case to get this one in our Revenue Administration Act. Yeah.
Lutando, Fabrizio, do you have any breadcrumbs to add to the response? Any insights, nuggets?
No,
Otherwise, second round, there was a question up here in the front as well. So 1, 2, and 3.
I think, let me add this. I think you asked whether bank-to-bank transfers are also inclusive in the data that we get. Yes, we get your bank transaction as well, because the e-levy didn't target only mobile money transfer. It targeted all financial transactions. So today, in Ghana, when you make a bank transfer, the Revenue Authority can see that data in real time.
If you allow me, this also goes to you, Isaac. And my clarification is, in terms of the scope of the transactions that you get from either the banking sector or the mobile money, is it just those transactions that have the e-levy component, or even those that are exempt? Does it cover, say, for example, deposits into an account?
Thank you. Thank you to the panelists. My name is Doris Akol. I'm coming into this discussion from the perspective of the underlying motivation for maybe taxation or mobile money payments. At least from my country, one of the reasons for introducing the tax was one, to make perceived telcos that were perceived to not be paying enough tax to pay some tax, or to pay more tax, but also to get people who are, perceived to not be paying tax, especially informal sector traders, to pay through mobile money transactions. Fabrizio, with all the research that you have done since, I think perhaps 2018 to date, is there any evidence to show that from a building tax capacity perspective, that these tax instruments are actually collecting more revenue? Thank you.
And Anders, up front.
Okay, thank you. There's a huge opportunity actually for tax administrations in Africa to enhance their tax collection using digital payment outlets. For us in Nigeria, we have actually updated our locally built inbuilt software in FIRS, which is the Tax Promax. After updating the Tax Promax between 2023 and 2024, we noticed a surge in many aspects. So, for instance, a code was built, and a mobile app code, but which wasn't used for payment, first of all, because we want to do it in stages. We have a USDT code built for taxpayers to retrieve their identification numbers, to verify their tax clearance certificates, to view tax types and rates, to locate the nearest tax office address and access general tax-related inquiries first, so that by the time they are used to this, we go to the next phase of using the mobile app to pay taxes. So with the updates in the Tax Promax, we noticed that taxpayer registration between 2023 January to June surged by 26.80%. That's from 721,000 taxpayers recording 914,000 new registrations between this period. We've also noticed an increase in collections, where the service recorded astronomical growth in the half year of 2023 and 2024 by 67.90%, with collections from 5.9 trillion in the previous year to 9.8 trillion in 2024. So we can see that this digitization actually has great opportunities for African tax administration to enhance their tax collections and other activities. Thank you.
Thank you very much. And one more question up here in front.
Two questions. First, do you consider the taxation of mobile money to be good tax policy, considering the distortionary effects you mentioned, the amount of revenue collected, and the administrative burden on taxpayers and the tax administration? So in other words, would you recommend other countries to follow the examples of, say, Kenya, right? And the second thing is, has the mobile money taxation spilled over into taxation of cryptocurrency transactions as well? Do you have anything to say about cryptocurrencies and taxation? Thanks.
I didn't hear the second question.
So maybe this time Fabrizio, Lutendo, and then you, Isaac, last.
Yes, I'll get the risk questions on the revenue potential of mobile money taxes. Again, I direct everyone to the recent policy brief that summarizes the key findings from the last 3 years of work on this topic. The main finding is that there is some interesting revenue potential, which is not as high as projected or as expected by policymakers when introducing the taxes in the first place. So it's somehow it's not insignificant, but it's still modest. We quantified at about 1% of revenue. So yes, taxes levied on mobile money transactions, they would typically contribute for around 1% of tax revenue, which is quite low compared to the initial predictions. And my colleagues have been doing lots of work on this, and they argue that there are several factors explaining this sort of modest increase in revenues from, again, the let's say, distorted expectations beforehand when introducing and designing such tools, which are, that the process of introducing mobile money taxes is often, could be chaotic and politically driven, and often there is lack of data to do any projections. To just, again, the fact that then throughout the course, and Ghana is an example, right? Throughout the course of a mobile money tax, there are lots of amendments made, often as a response to political, public unrest. The levy, in the case of Rwanda, has been reduced. So that undermines, again, and curbs, again, the revenue potential. Through simple, again, behavioral responses of mobile money users, they would just stop using it in the short term. So, yes, it's about 1% of revenue, which is not ideal, again, and it's much lower than expected. Thank you.
Okay. Let me take the question from Kenya. That the data we get from the central bank, is it only the e-levy related data? No, we're getting the full data. What we did is that, in your Revenue Administration Act, I believe you have the power to ask any institution, including the central bank, to furnish you with data. So we were going under that umbrella. The financial institutions, at standard reports they give to the central bank on monthly basis, we got a copy, so we could see the fields in that report that they do send to the central bank. So our request to the central bank was that, can you furnish us with that same data that you've been collecting from the financial institutions? And because this was also a new tax, the interest from the minister, from the executive was that high. So I believe it then offered us the opportunity for the central bank to give the data to us. I believe if it had been the normal day, they probably may not have responded to our request because of the way they got financial data. But at least this helped us, and we're able to use the entire data to do the analysis here. It was the entire data, yeah. Thank you.
Okay, thank you. So I will respond to the question on whether the taxation of mobile money is a good tax policy. My question is no, it's definitely not a good tax policy. For the reasons that I have indicated in my opening statement, the taxes that are imposed. So if you look at the reason why we have mobile money was not intended to compete with banks. Instead, it was intended to fill the gap that was created by the exclusion of the poor and people who live in remote areas by the banks, and to deepen or to increase financial inclusion and digital inclusion of the excluded people. And based on those reasons, the distortion that was created by the introduction of taxes sort of slowed the growth of mobile money. And when you look at the example that was given to us by Nigeria on the successes of mobile money to encourage or increase tax compliance, for me, that's a good example that you'd look at, and the benefit of using mobile money to bring to within the tax net people that would not have been within the tax net. The informal sector, people who run small businesses, and individuals that would not be caught where the tax authority would not have sight of those people. And therefore, I think there is a missed opportunity created by the taxation of mobile money. Because now what you're saying people who are using cash that you wanted to bring them within the net of the financial inclusion must remain using cash, because if you use mobile money, then you're going to be taxed, and you're going to be taxed highly. So it feels more like a punishment than encouragement for financial inclusion. Mobile money and cryptocurrencies, I don't think any tax authority, you can correct me, in Africa has found a solution for taxing cryptocurrency. I think there are attempts to tax cryptocurrency, and I don't see how you'd use mobile money to bring people who use cryptocurrencies to within the tax net. And I would be interested to see if there have been any studies that have been done on this. And again, I think cryptocurrency practitioners or people who use cryptocurrency are still moving under the radar in Africa. Thank you.
Anything from your side on cryptocurrency taxation? Yeah, Isaac? Like, does Ghana practice the taxation of crypto assets?
Yeah, crypto is still emerging, and even our central bank is not fully on top of it. So I don't think the Revenue Authority, we are currently looking at that. Probably will follow the central bank once they are successful, yeah.
Just on that, Joe is working on a report on an assessment of the
So, one of my colleagues, Joe, is working on a report on assessing the legal regime in Namibia in terms of crypto, and the idea is one would be able to do a similar assessment in other countries, including reporting and so on. So that may at least give some vocabulary for the tax authority to go into discussions with the financial regulators and the Ministry of Finance on that. So just a heads up. I think we will have something to share, Joe, say 3 months from now or something like that. So maybe we can, together with ICTD, do a small event on this and discuss some of these things. Thanks.
Thank you very much. And also, like from the outsider's perspective, I have the feeling that other communities are a little bit further ahead when it comes to crypto taxation, or it's like to the identification of crypto assets. I'm here specifically thinking of the FATF and the financial regulators, then the agencies in your jurisdictions working on anti-corruption and the asset recovery, where Kenya, for example, is also quite successfully recovering cryptocurrencies, and also like in order to follow FATF regulations and recommendations. But like that's just like an outsider's point of view. So where like other financial regulators and other arms of government like are a little bit ahead. So third round of questions, if there are any, but also be advised, it's now these questions and lunchtime. So be aware. But I do see hands. So of course, like it's a room full of tax people. So we all have burning questions, and lunch can wait. So 3 more questions to the panelists.
Yeah. Okay, so this relates to Ghana's e-levy. And Isaac mentioned that the 4 runners of Ghana's 2024 elections had actually promised to scrap the policy. Unfortunately, one of the 4 runners won the elections. That was just last Saturday. So it is inevitable that the e-levy will be scrapped. Now, the issue is, in February this year, we had a workshop in Accra, and our presentation showed that the e-levy had actually raked in about 1.2 billion Ghana cedis. And as we speak, that is as at November, we are close to 2 billion, an increase of about 6 billion Ghana cedis. And the policy is going to be scrapped. So we are going to create a revenue hole of about 2 billion Ghana cedis going forward. The other issue got to do with the expenditure in terms of even the infrastructure. Now, if it is scrapped, what it means is that we may not be able to fully utilize the infrastructure for the reason it was actually established. So these are some of the issues regarding policies in Africa. When policy is about taking off, there are political decisions that actually come in to disrupt some of these policies. And so this is just a lesson for other countries, that as we implement the policies, we should always have these things at the back of our minds. Fabricio, I want to know this. So Ghana's e-levy, in terms of incidence, is it regressive, progressive, or proportional? If you can explain this to us. Thank you.
Okay, thank you. I would like to ask a question concerning what would be the best approach, which would be recommended to widen the tax base while not hindering the adoption of digital payments. Thank you.
And the third question is Aya, in the front.
Yeah, so I don't know, this question could be addressed to Isaac or also to Fabrizio potentially, because he comes from a different background, the one of research, that's also the one that I come from. And studying what are the drivers of tax compliance, we kind of know that that is related also to the social contract, to the perception of, like how fairly taxpayers are treated by the government, by the tax system. And I'm wondering what people think about the fact that taxes on mobile money, such as the levy, for example, might have if you want, potentially unwanted impact on the long-term willingness of taxpayers to engage with the revenue authority because they don't feel potentially fairly treated. Because it seems like the levy had, was not welcomed by the Ghanaian population because it felt like, something that was bearing only on their shoulders. And so, yeah, I'm just wondering what you think about the short against long-term revenue gains of such idea, policy. Thank you.
Yeah, and the fourth hand?
Yes. So just a quick one to Isaac. Given the fact that the e-levy infrastructure and the data you are likely to get, data you have been getting from is quite useful for other purposes, whether for taxation of the digital services or even for identifying HNWIs. So if by any chance you were asked for advice from the new government, who are likely to scrap the e-levy? So instead of scrapping it, and you just say, let them charge it as 0%, so they still have the infrastructure in place and have the data access. Could that be a possibility?
Thank you very much. And now back to the panel.
Okay. So I'll start with Philip's question. That would be my proposal, that they should make the e-levy zero-rated so that the infrastructure stays. Then the obligations also stays. So all we'll do is that we remove the 1% and we put 0 there, and we still get the data. That would have been my advice in terms of telling the new government. Because the infrastructure is really, and we've spent so much, as my other colleague have said, to build that infrastructure, to just leave the infrastructure to rot. And also, we've made inroads that Kenya is envying us, that we can get live bank financial data that some revenue authorities do not have. But for this policy, we now have it. So they need to consider what happens to the inroads that we've made in getting financial data. That would have been my suggestion, to zero rate the e-levy. The other questions? So let's say you asked that in the long to short term, the effect of the e-levy. At least data is showing that what the government intended to get from the e-levy in terms of revenue, we didn't get it. We wanted more than 1%. We are still hovering around that 1%. So it would be good they start exploring other avenues that might give them more than the 1 to 2% of revenue that we are currently getting. So I may have to agree with the research data that probably this is not the most appropriate tax for now. Yeah.
Yes, for Dr. Combat's question. Yes, in Ghana we've been working, of course, on the levy with a survey in 2022. Just after a few months, the levy was introduced. My colleagues surveyed, I think, almost 3,000 informal workers in the Accra metropolitan region. And yes, the finding, of course, is that the levy at the time was highly regressive, burdening the bottom quintile of the income distribution. Of course, we acknowledge that there was a threshold which was partially effective, but among the respondents, the informal workers, the traders, subsistence level traders that were above the thresholds, they were paying disproportionately higher than the other quintiles. Totally regressive. We have done some work in Kenya as well, but I'll just need to get the results on that one, and I'll share. There is also, I think, a gap in terms of information and knowledge around these policies, which again affects the lower quintiles. Poorer taxpayers are less likely to know, about the technical aspects of a tax, and this affects their perception as well. As Celeste was saying, lack of knowledge also translates into misperceptions around the tax function, and misperceptions around the government's objectives as a whole. Yeah.
Any closing remarks from your side?
My closing remark is we should use the opportunity of the prevalence of use of mobile money for tax compliance purposes. to encourage tax compliance instead of taxing this financial technology, and to encourage more people to use the technology so that we can have visibility, and that will also assist in eliminating bribery and fraud that we see sometimes when the filing of tax returns is done physically or manually. Thank you.
Okay, my closing remark is that I agree with you that it should be used as compliance to enforce compliance. In addition to Philip's suggestion that if we could make it zero rate, I am also thinking that they can go further and maybe call it a tax compliance levy. For those who are not in the tax net, they get to pay the tax. And if they go to the tax authority and then they come onto the tax net, we waive it off. So my suggestion is that once your transactions are not captured on the tax roll of the tax authority, we put a certain percentage, maybe 0.01, to inconvenience you to force yourself into the tax net. Once you come in, we can probably even refund your money back to you if you were already compliant, but the system did not capture you, we can refund. But then if you were not on the system at all, then we impose this to you just to force you to come into the radar. That would have been my suggestion. Thank you.
Yes, from my side, I would say a few words about, again, the ICD perspectives on the topic, which is more about understanding the effectiveness of fiscal incentives to adopt digital merchant payments. Instead of thinking too much about the taxing more money, we really need to understand more which strategies are more effective in incentivizing adoption, not only by merchants, but also by customers. So we are really keen on that, doing more work on mapping adoption barriers, which is not only monetary, but also in terms of knowledge, know-how, IT readiness. So we're very excited to have this 3 or 4 years ahead to do more work on this. Thank you.
Thank you very much, dear panelists, and thank you very much to you, the audience, as well. I hope you enjoyed the session and as well enjoyed us, very particularly also looking into the unintended consequences, as the previous panel also cautioned us to look into. And with this, and 2 minutes ahead of time, we release you into the lunch break. Thank you very much.
Thank you, Dimitri. That was a nice close-off. And indeed, we are a little bit ahead of time. So from the previous 2 sessions, we've just learned that conjunction between digital ID systems and taxpayer registration presents a plethora of opportunities of interactions between individual government agencies, and digital payments between merchants can give us broader views or insights into tax compliance and the ensuing enforcement thereof. But there's more research that still needs to be done. So this discussion, I'm hoping that as we collect each other's numbers and we have these conversations, that they'll still be ongoing even after this conference. I just have one announcement. We had some wireless chargers that were in the foyer for everyone to use. If anyone has moved any, please make sure that you return them to the ushers or to the table there at the back. It would really be very appreciated. Our lunch break is going to take us about an hour. It's going to take place at the same place it took place yesterday, but just for the benefits of anyone who doesn't know, it's going to be downstairs, down the hall, and into the marquee outside. Enjoy your lunch and see you back in the hall at 1:15. Oh yes, we also have a group photo, by the way, before lunch, just so you know. Sorry, almost forgot that. The group photo is going to be taking place here in the front. I think I did announce this right at the beginning, though, so those who paid attention would remember. We should be taking the group photo here. We need a few people standing on the stand They're just going to help us move the chairs down here so that we can have at least 4 sitting. The other queue is going to be there, and the other one is going to be on the podium. The photographer who's sitting right at the back with the white top is going to help us position ourselves. Thank you. A conference so that we can be able to wrap up in time. Apologies for the few minutes that have just taken now. I think it's about 7 minutes now that we've overrun. Hopefully it's not a train smash by the end of the day. One quick announcement. People have been asking if the slides that are being used during the conference are going to be shared, and yes, they are going to be shared. Okay, so worry not about that. And don't let that take away your attention, taking too much notes, because they're going to be shared. Now, our next session, and I hope you enjoyed your lunch, by the way, not to be rude. Our next session is on data exchange systems, a nice follow-up from the previous sessions. Unlocking successful interinstitutional collaboration. It will consist of a policy-oriented panel discussion on the potential of consent-based data sharing agreements across public and private institutions to strengthen tax administration. And there is going to be a particular focus, especially on the regulatory background enabling such agreements and on the international regional dimension. Our scene setter is going to be Martin Hearson, Research Director of ICTD. And our panel is going to be made up of Elia Lungu, Acting Assistant Director of Statistics and Data Management from the Zambia Revenue Authority, and Mili Nalukwago, Director of Statistics from the Central Bank of Uganda, and Leila Latif, Lecturer and Research Lead on Public Finance from the University of Nairobi. Our moderator will be Doris Akol, Senior Economist from the IMF, the International Monetary Fund. Martin, please take the lead, and the panelists and the moderator, please take a seat in the front. Thank you and welcome.
Hi, everyone. It's going to be a slightly different kind of scene setting for this panel compared to the excellent presentations from my colleagues this morning. Partly that's because much of the discussion, certainly in the first panel, already touched on data exchange in some detail, and also because it's the area on which we're really entering to a new field of research for us. So while we have some research findings that we have already talked about, this is much more about thinking about how to understand this topic and how to develop a research agenda from our perspective. So my scene setting comments are going to do that, and then I will leave the experts to talk in more detail about the substance. Where do I point? This way? Can I have the next slide? It doesn't seem to be advancing. There we go. So what do we mean when we talk about data exchange? How can we conceptualize it? I want to talk about it in these 3 buckets. So the first is to look at where the data is coming from. And there's 3 potential sources. The first is from revenue authorities abroad. So there's 3 typical modes of exchange of information between revenue authorities. You have information exchange on request. You have spontaneous exchange, where an investigating authority discovers some information they think would be of use to another partner and shares it. And then you have automatic exchange of information, the transfer of bulk data. And in the area of automatic exchange, there's now a large international architecture. We heard some discussion about it, particularly yesterday, for some of the countries that are participating. I think 6 African countries are now in a position to receive data automatically, with another 6 committed to get that in place by 2027, although those commitments, I think countries have found it often takes longer than they expect. So the majority of the continent is not currently participating and not currently planning to get there soon. But for those that are, there's now actually 3, soon to be I think 4, forms of data that are exchanged automatically. So there's information on financial accounts, on individuals' financial accounts. There's country-by-country reporting information on large multinational enterprises. Within the OECD and the EU, there's an exchange of data automatically on sellers in online platforms. And there's soon to be exchange of information on real estate assets, which I think is being driven through the G20. So that's revenue authorities abroad. And I would say of the 3 categories, that's the only one of the 3 where it's truly a reciprocal exchange in most instances. So then we move to the domestic sphere, and we have public institutions, ministries, departments, and agencies. That may include, in a federal setting, other revenue authorities. It may include customs agencies, central banks. We've heard about various types of registries, corporate registries, vehicle registries, property registries, city authorities, another category in the domestic public institutions. And then on the private institutions side, we've talked quite a bit about financial institutions, banks, mobile money providers, industry associations, real estate agencies would also fit. There's many more than this list. But as I say, much of what we see in the domestic setting is primarily a transfer of information to the revenue authority because of the nature of taxpayer data and what can be shared. As for the uses, there's a list here. I don't propose to go through it in detail, but just to mention a few things briefly. So there's registering new taxpayers, the extensive margin, as we would call it. And in that category, you have the kind of mass registration that Celeste talked about, and also then identifying high net worth individuals, as Kwame talked about earlier. We have facilitation processes, for example, pre-populating returns would be an example. We have risk assessment. An example of that would be where automatic exchange information from abroad is used to identify assets that have not been disclosed or income that's not been disclosed. Monitoring, cross-checks, for example, with credit card statements, pensions was mentioned this morning, company registries and so on. Audit is self-explanatory. And for research, we haven't really talked about that so much, but the use of third-party data combined with tax administration data for research is something which at ICTD we believe is very important. And then in the middle you have obstacles or enablers. I'm going to talk about a few more of these in a minute, but I want to just say we can really think of them in these 4 categories. So we have the technological aspect, which we've dwelt on quite a bit. We have the institutional aspect, both within the revenue authority, the institutional dynamics that you need to have right, but also between institutions. We have the legal and regulatory preconditions. But really, within all of these, probably the overarching thing is the politics, because all of the other things depend very much on getting the right political support, overcoming the political obstacles. Okay, next slide, please. Okay, so I just wanted to say, listening to the discussion, I thought it was quite helpful to just think about different modes of data sharing that have been mentioned. So there's data sharing on request, where the revenue authority would make a request to another authority for data, and in that sense it could be a request for an individual piece of data or for an entire data set. There's the then regular periodic sharing of data sets, annually, monthly, so on. There's then automated requests or cross-checks where the revenue authority uses an API to go into another data set and check information. And then there's the kind of full real-time seamless integration inside a centralized data warehouse that seems to be often regarded as the ideal endpoint to get to in the digitalization journey. But it's worth saying that in some instances, probably some of the other types of information exchange are likely to remain the primary mode for certain forms of data. Next slide, please. So then, challenges to overcome. So this is another way of breaking down that middle box in my first slide. So the first two are around data quality, format, and purpose. And again, I think Celeste unpacked that very nicely this morning. Third-party data can strengthen the quality of Revenue Authority data, but it may also itself have quality issues. And the format and purpose of the data may not match the purposes for which the Revenue Authority is using it. The example I think that we heard a couple of times is in Ghana, the occupation field in the national in the Ghana card system doesn't necessarily match with how the Revenue Authority might want to use that same, the purposes it might want to put that same information to. Another example of that would be the country-by-country reporting data that's exchanged internationally, where both the threshold for company size is rather high, so many smaller companies on which the Revenue Authority might want information are not included in the data set, and also certain other data fields are not there, so you don't have information on related party transactions that might be of use. Second category of challenges then are legal and institutional resistance. So I put these two together in the sense that you need a legal framework that will both protect data and also empower the Revenue Authority to obtain data. But as we heard from Isaac, sometimes even where that legal power is in principle there, in practice, it may not be so easy for the Revenue Authority to actually still get the data, whether that, especially if it's supposed to be volunteered by financial institutions, for example. Yeah. Well, one example of this actually from the international sphere, I remember many years ago a meeting in a European Revenue Authority talking about whether or not automatic exchange of information would be beneficial to lower-income countries. At that point, we were not in the world we are now, where it's become a part of the international landscape so clearly, but it was in the EU. And an example of institutional resistance there was a certain offshore jurisdiction had been compelled to participate in the automatic exchange of information. And they did so not by sending data in a machine-readable format, but by printing out an Excel spreadsheet and faxing that to the other jurisdictions. So there are many forms of institutional resistance that may exist even where the legal framework is clear. Analytical capacity and capacity to automate then, so capacity within the Revenue Authority both to analyze the data when it comes in and also to use it administratively in an automated fashion because of the volume. And then finally, these two risks at the bottom, so the behavioral responses. So as we move towards greater and greater surveillance, if that's the right term, through different modes of transaction, taxpayers may, for example, switch back to cash to avoid transactions being recorded. And the risk of misuse. So that's the risk of misuse of data collected from one source or another. It's a particular concern, I think, for those, particularly why we had the discussion around secure perimeters for international data because of the fears of misuse there. Next slide, please. So just finally, I wanted to talk about then some research questions. And as I've been listening to the discussions over the last day and a half, it's been really helpful to think the question is not just how to do data exchange well, but it's also about what kind of data to exchange and when. Because we have many people reiterating the point that too much data is much of a problem as not enough data. So on the how questions, we can ask what frameworks and systems need to be in place to make data exchange work. We can ask how to do that in a way that respects and protects taxpayers' rights and privacy. And we can ask then what are the key drivers of success where countries have done that. And as I mentioned, those might be institutional, legal, or they may be political, and they may be technological. But then the what questions. So I'm sure there's more work to do to refine these questions, but as a starting point, so we might ask which sources of third-party data have been most useful for different purposes. So if we start from what's the business driver of exchange of information, what data specifically from what source is going to be most useful for the most common purposes we observe, and which modes of exchange, going back to that slide I had with the 4 modes, are most effective in different circumstances. And then finally the when question. So I've realized that none of my what questions or when questions actually start with what and when, but please forgive that. So under what preconditions, so when, does investment in a particular data exchange become cost effective? Given the cost involved in setting it up and then processing the data, I think it's a particular concern for international exchange. The cost is significant, and I think there's little research that answers the question of when would it be the right time for a revenue administration to commit to that level of expense. So those are the research questions. I'll pass over now to the panel of experts to answer them.
Thank you very much, Dr. Martin Hirson, for very nicely setting the context for what I know will be a very interesting, insightful discussion. As tax administrations mature from tax administration 2.0 to tax administration 3.0, data is critical because tax administration 3.0 requires that the tax administration will be data dependent, both from a collection perspective and an analytic perspective. But this is not possible without data exchange, and that's why the conversation around data exchange becomes critical, particularly exchange not within or intra-data exchange within the tax administration, perhaps from tax and customs, but also inter-institutional or cross-institutional collaboration, and that is the kind of discussion that we are going to see. I have with me a very a panel that will bring all the different permutations to this discussion, and I'll start with Dr. Laila Latif. Doctor, if you could set us starting, what sources of third-party data do you think are priorities for revenue administration, and why? I start with this with a non-tax administrator so that we can hear some external perspectives, because tax administrators, sometimes we have our boxes ticked, but it's good to hear from someone that is not a tax administrator. What are the data sources with your experience that you think are a priority, and why? Over to you, Doctor.
Okay, thank you very much. I'm going to speak loudly because, at the back it's been quite dim. I want to start off with sharing a proverb from Sri Lanka that I came across, and that proverb says, "You cannot swallow a pill without letting the throat know." So you can interpret that in many ways, but for me, that interpretation is very simple. If you want to get access to somebody's data, you have to go to the source. And the source is the taxpayer themselves. But I think some of the taxpayers are really shifty that you're not able to get the kind of data you want from them. And that's the time, Doris, you need to think about third parties now. Where do we source out this data from? And very interestingly, we were with the Premier Tax Office, which is part of KRA's large taxpayers office, and we were discussing the population of the high net worth individuals register. So Kenya has about 7,200 dollar millionaires, and the PTO has been able to identify about 850 of them. And they're like, how are we going to get more information in terms of who are the remainder of these high net worth individuals so that we can have our register really populated? And one of the participants at that particular forum we were at, she was a tax administrator, and she says, you know what we do? We look at the newspapers. We try and see what are the highlights being given by journalists in terms of who purchased what, when, who benefited from certain, government contracts. And we try and sit on the road sometimes to see who are the ones driving the posh vehicles, right? We're seeing really good cars on Nairobi streets now, and we want to find out who are these people so that we follow them, and we are able to check against the properties that they own, vis-a-vis the kind of tax compliance that they're involved in. So the media becomes a really important source, like a third-party source, to get this data on taxpayers. The journalists are also very important, and the bloggers, because right now if you go on the X platform, there are particular two bloggers from Kenya. I'll not mention them, but they're very provocative in terms of sharing a lot of data on specific individuals who are beginning to become very wealthy very quickly. So that becomes another form of, a good source that we're able to now go ahead and say that this is one of the information that we require. There are different approaches that also different countries take up, and I'll share with you my experience in Uzbekistan as well as in Djibouti. So Uzbekistan State Tax Committee has always been having problems in terms of getting data to establish whether there has been tax fraud or there has been non-compliance by individuals and businesses as well. So what they decided to do is that they decided to now come up with an incentive for the public. So they had this approach, I'd probably call it a crowdsourced, indirect data recording sort of a scheme, whereby they told the citizens of Uzbekistan, every time you go and you purchase a product, either from the supermarket or the kiosk or even an individual, ask them to give you a receipt. And there's a particular digital platform, we're going to ask you to load up that receipt for us. If you do that, we're going to give you a refund on the VAT amount that you have paid for. So that was one approach the Uzbeks decided to take up to invest in the public as sources of information so that they'll be able to generate data on businesses. And when they did that, they were able to look at the statistics of about 47 medium-sized businesses in terms of what they were reporting vis-a-vis the customers who were buying from them and the receipts that they were posting. And they were able to see the discrepancies and build up a sort of a taxpayer's profile, which became really important for data collection. And we don't have to go far from here. Djibouti, our neighbor, is also doing something really incredible. The Ministry of Finance is going to start working with the private sector. And there's this particular private sector, they're called Wingu, and they're the ones who are now really, I think they're the ones holding a lot of information, not only of Eastern African companies, but also Central African companies, because a lot of data is going through their portal. They're also providing licensable agreements with other tax administrations, like I think even with Ethiopia, with Somalia, with I think even Tanzania, in terms of hosting data centers to collect information on multinational corporations, as well as other foreign corporates that are involved in Djibouti's shipping industry, because Djibouti is like really placed at the center of the maritime zone, right? So there are about 180 multinational corporations doing work around that. That data is sitting at the data center of Wingu in Djibouti city. And I think that's really going to be important when we're looking at the Africa Continental Free Trade Agreement, by which I think by next year there'll be a lot of movement of people and capital across the countries. And that sort of data will be really crucial for tax administrations. So Kenyans will want to know the KRA that are here. You'd want to know what I am doing in Rwanda and why I keep going to South Africa, what businesses I have there. And I think that data center from Djibouti would be a really important source to tap into to be able to come up with that profile that we need. So in terms of my answer to you, it's the public themselves, right? Like the example of the crowdsourcing in Uzbekistan, the media, the journalists, the private sector, and of course, the other thing I forgot are the financial institutions. Yeah. And this is where you have the high net worth individuals. Right? They have this incredible, sophisticated wealth management strategies that they come up with that you can't really know when they're paying taxes and when they're not paying taxes. So with the Premier Tax Office, they're beginning to work with Safaricom to come up with an API system that they're now going to ask, real estate investment funds, hedge fund managers, insurance companies that are involved in providing wealth management strategies to the high net worth individuals to be sharing that data with the PTO, the Premier Tax Office, so that they're able to now populate their register to come up to figure out, the remainder of the $7,200 millionaires. So these are the sources that we are seeing. Of course, that will be important going forward. I hope I've answered you.
Thank you, Dr. Latif. I think picking up from your answer, the underlying theme here is information sharing and data exchange from those sources and some other maybe more obvious and non-obvious sources would help with the information sharing. Building on that theme, particularly for information sharing, I come to you, Millie. What is the benefit of these cross-agency and data sharing arrangements from obvious sources within the public institutions, non-obvious sources from the private institutions and private sector? What is the benefit of this kind of arrangements? What is the benefits of system integration, where system integration is required, with a particular focus on strengthening the effort to strengthen tax administration systems, particularly in Africa, where this data exchange is still a work in progress.
Thank you, Doris. Thank you, ICTD, for this opportunity, and RRA for hosting. It's good you've said tax administration, because I'm coming from the central bank. So I'll try to paint a picture on the benefit. But we must know that the benefit of these agreements and integration is not only for tax administration. It cuts across institutions in the government and in the private sector. So I'd like to look at two areas. We have the soft side, the agreements, and then we have the system integration, the technical side. So when we get to the agreements or the memorandums of understanding, it's important that we look at the soft parts. Like if you're engaging with an institution, do you have empathy? Do you understand what their system is? Do they have the skills? You may want data from that system, and they may not be having the skill to extract it. So go a deeper mile to try and understand, build bonds, identify what are your common goals. A number of times when we are looking at agreements, we are looking at our side only. So I would advise the tax administrations that as we are having these discussions, what is in it for the other institution? What is in it for the individual? What is in it for the revenue administration? And you'll always find that answer is there. So try to answer that as we are trying to put together these agreements. Let's also look at conflict, in case there's conflict. So it's important as we are developing these agreements and MOUs, how do we address the conflict? So the benefit of this is that it helps us to structure this kind of arrangement that we have. But we also must know that there will be institutions where we will get information and we are not going to be able to document. And I'll give you an example. While I was still working with the Revenue Administration, we had to get information on rental income tax. And we had to engage the local authorities, LC1s. I don't know what they are in your respective countries, but those local authorities who handle sales. And they gave us a lot of information. We had to engage them. We had to give them some motivation in terms of money. And they gave us a lot of information that enabled us to collect. So when you look at the African setting, yes, we will have the formal ones, which are aligned to formal institutions, but do not forget those other ones, which you may not be able to really align. And we also need to look at the capacity building. So these MOUs that are documented help us to clarify the structure, the scope, the components of the kind of information that we need to share. And that is key. What is it that you really want? Because you're not going to get all the information the way it is from the providing institution. So what is it that you're really interested in? The frequency, the mode, and all those areas. So when we get to the point of the system integration, because after you've agreed on the structures and all that, then you get to what are the modes. I've talked of the mode where it is you engage and these people give you information. It could be email. We need to put into consideration all these because we are not going to get a quick fix immediately. So it's important that we consider all these other methods as we move to the recommended ones. We also need to consider what kind of format do we want this information to come, or what kind of system are we going to put in place? Is it a centralized system, which has been talked about ever since we started yesterday, the centralized whole of government? whereby information moves from the various institutions into a platform where then everyone else gets there to get the information. But there's also the decentralized, where you get information directly from a peer institution. That's also available. And then the hybrid, where you either pick from the centralized or you are able to directly link. And the hybrid enables you to be able to be scalable and flexible. So as we are coming up with these MOUs and looking at how we integrate our systems for information, we've already talked about this. It's very important to consider the standardization. I know we are very interested in the information for tax administration, but we are also not going to cause a change in the way data is collected in other institutions, because every institution has their mandate. So it's important within the tax administration to have a standard that cuts across, that if we want information from the local government or from wherever, what should it look like when it gets into our system? That is very important for us to be able to use that information. We also need to look at the interoperability. It has been talked about. How does the information interoperate with the information we have within the tax administration? We also need to look at the security and authenticity. One of the things that has been preventing institutions from sharing information with other institutions is that they are not sure how you're going to take care of their data. What if it leaks out? I am coming from a central bank, and we are the bankers of government. So if you want me to give you granular information, what if it leaks out? So those areas have to be very, very paid attention to if we are going to be able to share information. I'll now quickly give what are the benefits. And the benefits, like I said, are twofold. There's this saying, I don't know whether it's saying once only. It was mentioned yesterday, I think, by Irembo, once only. The benefit with integrating or sharing information is that the citizen will be able to give information to a government institution once. That is because you're able to get, so on the side of the citizen, think about the citizen, they don't have to keep giving you information. And on the side of the institutions, you're then able to share information. Then in respect to tax administration, like Doris requested, the benefits are immense, and Hersen talked about them. One of them is the data-driven audits. You talked about audits. I don't know whether it's still happening now, but in those days, there would be random audits. You go out and audit. But with sharing third-party information, you will be able to have data-driven focused audits. You will be able to do risk assessment and profile the taxpayers using the information that you're getting from the various institutions. However, if in the tax administration you've not provided for standardization, interoperability, that analytics, you will still have a challenge because it will still be siloed within there. So it's important that you work on those frameworks and are able to leverage. You also will be able to get a whole view. One of the panelists before said that he can bet that no tax administration can have a whole view of a taxpayer. But third-party information that is structurally brought into the tax administration will enable you to look at your taxpayer, their water bill, their electricity bill, their property, their vehicles. By the end of the day, you have a full picture of what this taxpayer looks like. You'll be able to know how much they've paid and how much is due. By the time you interface with them, the questions will be few and the resistance will be low. They'll know that you know, and they'll really pay. Compliance costs will really go down. Other benefits really are about collaboration. When you share data, you're able to clean it. So even the institution that is giving the data to the revenue administration or wherever, and the revenue administration, by the way, the Revenue Administration should also be open to sharing data. Because when you share data, you're able to clean. The other person who is analyzing and using it will be able to help you. But when we get to the MOUs and the agreements, it's very key, especially in African settings, that we have empathy. So if Millie gets your data and she's in Revenue Administration or Central Bank to use it for economic analysis, it's very important that if there's a gap, let me give a practical example. If I got data on trade statistics and I want to see the economy, the movement of the economy, it's possible there are some gaps in there. It's very important to get back to the provider before you publicize this information. You need to build trust. You get back, they sort out their data, and then in that way we'll be able to move together. And that is key. Those are the soft things that you'll not find written in a book here or there, but are very key for us to be able to move and be able to use this data. I think I hope I've addressed your question. Thank you.
Thank you, Millie. Two things that I pick out from what you said. You mentioned standardization of data that comes as a result of cross-institutional collaboration. And I think this is one area that where two institutions or two or more institutions are sharing data, it's within the data gathering protocols. It enhances the standardization of data fields that we are able to collect data that serves the mandates or the interests of all the institutions. And by so doing, we eliminate or reduce duplicated activity by all the institutions. I also like, I think one of the other benefits that could come out from what you have said is that sometimes revenue administrations are at the forefront of doing this, leading to the maturity or e-government-wide data sharing. Sometimes revenue administrations are also beneficiaries of e-government-wide maturity of systems. But having talked about all these benefits, data sharing as a concept has to actually materialize. And so I come to you, Elia, either picking from your experience at the Zambia Revenue Authority or generally, what form does this cross-agency sharing of data, what arrangements does it take in actual form? That is, how is data actually effected for the benefit of the institutions that are actually sharing the data? Over to you.
Thank you very much, and thank you for the invitation. So, in terms of data exchange, I think I can call it, we have more of a two-tier system. So the priority number one is integration with government agencies, and then looking forward, we're also looking at ways in which we can sort of integrate with the private sector. So before you go to the private sector, you need to get your house in order. So I think that's basically the approach. But when we embarked on our digitalization journey, it sort of took the form of, we worked in silos. The tax authority is automating systems, the pension authority is automating systems, even the registration, for example, like the registration authority is also, but from a legal perspective, the ZRA Act, which gives us authority to do what we do, is separate from the other legislation that govern the other. So the first thing that obviously you need to do is to harmonize the law. So how the form in which they take, we approach them on a, for example, a bilateral basis. We'll go to the registration authority. Firstly, our legal experts need to review the law to ensure that us sharing data with them and them sharing data with us does not break the law, in simpler terms. And then the other issue is now what, like Millie was saying, the issue of standardization. What is the form of our data and what is the form of their data? How do we link the two? What do we need to do? So we come up with a memorandum of understanding. Obviously, technical teams will be involved, and once maybe the legal aspects and the technical aspects are done, and then we sort of, what can I say? operationalize the kind of relationship. So I'll give an example. When we started as ZRA, I think our digitization started around 2012. For the registration authority, I think it took a while for them. They started their modernization around 2016. So there was already a 4-year gap. But what we discovered when we sat on the table was how do we create a mutually beneficial relationship? So when we started the talks of integration, we discovered many things. Because we are operating in silos and under different legal frameworks, we had situations where a taxpayer is registered with ZRA and they're complying, but with the registration authority, it also has like annual legal obligations. So you'll find they're complying on the other side, obviously because the penalties are very punitive for tax, but there's no compliance this other side. And also, what we would also notice is we had cases of many taxpayers registered with the registration authority, but not registered for tax. And they would just carry on. So what that did was we streamlined the process. So in its current form, ZRA doesn't do any registration. So if you want to register your business, you go to the registration authority. The moment you complete the process, you are automatically registered for tax. And the obligations for tax sort of kick in almost immediately. So what that has done for us is, one, it has improved our data quality in terms of the taxpayer register. It has also helped us enhance on compliance because some of the information that we're picking from the other side's information, like beneficial ownership information, that in the absence of the partnership would not really have access to. Another example I can give is we have a statutory body in charge of pension contributions. It's called NAPSA, National Pension Scheme Authority. So they collect information on employment records and benefits. That information is very useful for tax administration, the pay-as-you-earn. So similar to what we did with the registration authority, we entered into an MOU. Of course, you do the legal review and all the technical aspects. And just like like happened in the other case, we would find on one side, someone will report they have 100 employees, for instance, for pension purposes. But when you come on the tax side, there's nothing. And sometimes, again, on the other side, you find data, and on the other side, there's no data for the reason I stated, because tax compliance with tax is quite punitive. Non-compliance is quite punitive, so people obviously have an incentive to comply. But because maybe the laws the other side are relatively weaker, so there were those data gaps. So obviously we entered into an MOU, and obviously that resulted into an improvement in our pay-as-you-earn collection, because at least now the compliance monitoring was a bit enhanced. I think there are many examples, but those are the two I can just pick. Thank you.
Thank you very much for those examples. I think it gives us a really good segue into the next question for Dr. Latif here. And again, and I'm mindful of the time, so just asking data, the different types of data that you talked about, the ones that we have seen the examples of, are they themselves good or comprehensive? How do they compare with data from other bodies that you have interfaced with in the work that you do, knowing that you don't only work with, you don't only interface with tax administration, you interface with other bodies. And if they are different, is that a challenge in itself, and what can we do to resolve that challenge?
Thank you. So I think different public bodies have different approaches to the types of data they store, they manage, and the kind of quality or inequality of that data that they keep, as well as the extent to which they even analyze that data going forward. So I think with the KRA, they have a more detailed approach to the storage of data and the analysis. However, they're tasked with sensitive information, right, which is financial statements, bank statements, customs declarations, and generally information that should not be disclosed to the public because it's confidential. But the same approach doesn't apply to not different, but other public bodies. Like you'll have the Ministry of Lands, you'll have the Nairobi City County, you'll have the Ministry of Transport as well, that also has access to data on taxpayers, but it's not of the same quality in terms of what you can analyze out of it. And I'm going to explain this. So we've got financial data, which is sensitive. That's in the prerogative of the Kenya Revenue Authority. We then have a different type of data, which is heterogeneous sort of data, which could be seated with the Ministry of Lands. So we're talking about the cadastral records, we're talking about property registers, we're talking about land ownership, right? And that data in itself is quite limited because it doesn't take into account the different transactions that follow that data. And then we also have demographic data. And this sits within the devolved units in Kenya. So the Nairobi City Council is going to have data on, properties within a specific locality or a ward, businesses that have been registered in a specific locality, and the kind of trading that is taking place. But all this information is really not filtered. It's just numbers and names. There's no analysis that is done. So in terms of the exchange of information, for example, from the Ministry of Lands to the Nairobi City Council and KRA, there's going to be a lot of problems in terms of identifying the true or even the credibility of that data. And I'll give you an example. So with KRA, I think, Millie, you also mentioned rental income, right? So KRA is going to have information on rental income tax that is being paid. The Nairobi City Council is going to have information on the property rates and what we call the land rent and the land rates that are being paid on a specific land parcel. And then the Ministry of Land is going to have the ownership details of the person who owns that specific land reference. So what now happens is that if you want to try and create a profile of this particular taxpayer, and you want to start from the Ministry of Lands, like are you the owner of land reference number ABC, you're potentially going to get that maybe Leila Latif is the owner of this land reference. But now when you go to the Nairobi City Council and you try and get that land reference owner and the ownership details there, my name may not be popping up because I have now decided to maybe either subdivide that property, issue it out as a tenant in common to somebody else, or there's been some different sort of transaction that has taken place in that property, and the person paying the property, the land rent and rates is not being captured as Leila Latif. Then when you go to KRA and you try and ask yourself, like, which information may not be disclosed, is like the rental income tax is being paid by who? Is it being paid by Leila Latif on LR number ABC? And it's going to be a different person's name. So here you have an instance where you have data on a specific property, but when you're trying to read it to create a profile, you're not really getting who, if I may use the word, the beneficial owner really is. And while in Nairobi this may not be a huge problem, the coastal region, the counties that are there, Kilifi, Mombasa, Malindi, it's a huge, huge issue. Because number one, the Ministry of Lands there, in as much as it has digitalized, it's supposed to use the digital system to be able to make those changes in real time. The infrastructure does not support the capacity of the Ministry of Lands there. So you try and get onto the portal and you want to get your transaction done, there's going to be some sort of an issue that doesn't allow you to complete the transaction. So you go back to paper-based work. Now, because they're recording the information on their black books, that information has not been updated with the central registry. That information doesn't come now to the income tax department of the KRA as well. So you will have these mismatches in data that are taking place, and Mombasa County has really been flagged out by the government in terms of portal. And we've been hearing since yesterday conversations around the whole of government approach, right? So under the Ministry of ICT and Digital Economy, they wanted to set up a common register that the entire government bodies, all the public bodies, parastatal, state-owned enterprises would be able to use to update information. And KRA was one of those entities that was supposed to be drawn in to design that particular data management portal. But what happened is that we went into a discussion about, wait, there's certain information that should be public, but there's other information that should not be public. And taxpayers' information, right, should not be public. And that's the debate that now the Ministry of ICT started having with the task force members. And the arguments were, but tax is like a public good. We're using tax for purposes of providing public services, and therefore that information must be public. People should know. For example, for me to use the example of our president, Ruto, how much taxes does he pay from his private investments? And of those taxes that he pays, how much has been utilized or redistributed to support the area where his locality is? So those are the arguments that that's the kind of tax transparency that we require, but it was a lot of pushback. So what the government then did is that because we need to have a seamless, interoperable sort of a system across all government departments, we're going to set up what we call the Council of the Future. And this Council of the Future, hopefully, it's going to be established come 2025, 2026, because that's the short-term vision the ministry has. Once we have the council will be the one to decide and say what kind of a central depository of data systems do we want so that we're able to have this information coming in. So that's my response.
Yeah. Very interesting, and looks like Kenya has maybe leapfrogged in terms of data sharing across different institutions and perhaps centralizing data sources. Coming back to you, Elia, I want to know, borrowing from Dr. Hearson's slides, where he put that triangle, the enablers or barriers to data sharing, and he broadly labeled it political. Can you tell us about some political, and when I say political, I also include socio-cultural, economic, behavioral factors that could enable or indeed constrain effective data exchange? And while you're saying that, perhaps could you also throw some light on whether the maturity of a country's technological infrastructure also has a bearing on this? Thank you.
Okay. Thank you very much. So maybe I'll start with the constraints. And the obvious one is legislative barriers. Mm-hmm. I think that one is, I'm sure it's an experience with most people. I'll give an example. We, as a tax authority, we want access to bank transaction and level details from the commercial banks. But on one hand, we have the Central Bank Act, which sort of mandates the financial system to report. But we also have the Banking and Financial Services Act, which has specific provisions which doesn't allow the commercial players to share their information with anyone else other than the central bank. So much as would, maybe on a case-by-case basis, would have some access, but that already creates a barrier for data exchange. I think the same goes for mobile money, access to transactional level mobile money. Our telecom sector is regulated by, we call them ZICTA. They are our ICT regulators. They have a different legislation. And in that legislation, there's no provision for them to share that information with us. Maybe not transactional, but maybe aggregated data. So already that sort of creates a barrier for, much as this information is useful and the benefits are known, but we cannot have access to that information because of the legislative environment. The other constraint, especially for our colleagues in other government departments, is funding for systems infrastructure. Of course, tax authorities, we are relatively well funded. So we are able to invest in more updated data systems, but it's not the same. So this is also, it also contributes to the maturity question you asked. So we are in a situation where we are ahead of the pack. 2 years ago, government introduced government service pass, where the intention is to have all government processes on one window. Yes. Similar to the experiences our colleagues from Rwanda were sharing. So now, from experience, what has happened is our system doesn't speak to that because it's more advanced. So we've been, for now, exempted from that. We are separate because others are still trying to onboard so that's, but of course the underlying issue is just the investment issue. Then another constraint, especially for tax administrations, is, most of these tax administration systems that we use are not homegrown. They are proprietary. So meaning there's lack of access to the source codes. I'm not an ICT person, but I have an idea. So not having access to that limits how much modifications you can do to a system. Probably it comes at a higher cost. So that in itself presents some kind of barrier. But I'm happy to just let everyone know. For ZRA, we've moved away from that. We actually develop our own system. The current system we're using was developed by ZRA. But still, our colleagues, maybe some of the systems they're using are not proprietary, so it still brings that problem. And another barrier is there's a digitalization gap in some of our government agencies. I'll give an example of Department of Immigration. I know they're doing some work to digitize, but that process of getting a national registration number is purely manual. And the national registration number is a mandatory requirement if you want to register for a TIN. So if we want to do any cross-matching, cross-referencing, data matching, you can call it, we have to operate offline. Maybe they give us an Excel file that someone was manually entering, and then we cross-reference with that data, but that's a very inefficient way of doing things. In terms of enablers, again, the funding issue. I think there's need for government to invest in system infrastructure and also public awareness. We need to educate the public on the efficient use of data. Because, like Millie was saying, if there are data breaches, that destroys the trust between the public and the government. So there's a lot of work that we need to do, public awareness, showing them the benefits of information exchange. Obviously, from their perspective, you can explain it in terms of shoe leather costs, the reduction in the compliance burden, transactional costs. So I think those are my 2 cents on that issue. Thanks.
Thank you. Thank you very much for those insights. Millie, coming to you as we sort of come to the end of the discussion, having heard everything and having yourself said for purposes of effectiveness, for purposes of efficiency, removing duplications, what steps are expected of revenue authorities and the other institutions that they will share data with? What steps do they need to take for that data exchange to be successful? Here we are looking at unlocking successful interinstitutional collaboration. So what steps do institutions need to take to make this data exchange very successful and very effective? Because ultimately all the institutions involved are looking at advancing their mandates. And specifically for tax administration, we are looking at improving compliance, we are looking at serving taxpayers better.
Thank you, Doris. I hope I have enough time because I love this topic. So you all listen. This is the gist. So we've talked about exchange information. The information is now home in our institutions. What do we need to do? First, we need to have a comprehensive strategy. Do we have a strategy? A strategy that is involving legal, is involving technology, operational, organizational changes, and is going to address fit-for-purpose data. Because we don't want to bring everything that we won't use. So do we have a strategy? Do we have a data policy? Do we have a framework to implement this? And in here, we are going to look at what is the legal. And Elia has talked about about the legal. What is the legal framework? Data access rights, data sharing agreements, complying with privacy laws. Have we considered that? We need to consider that within. As we are bringing this data, are we complying? We need to look at technology. Again, we've talked about technology, but this technology, is it scalable? Can it allow us to integrate the data? Does it have analytical tools? We may look at technology that will bring in this data, but we need to be particular about this technology. As this data comes, is it going to support us to analyze this data? Remember, we've talked about multiple sources. So for me, I'll put this third-party data in the realm of big data in terms of the variety. You will have a lot of variety. For some data sets like mobile money, if we are lucky to get transactional based, it will have high velocity, big volumes. So this platform that you're having, is it scalable enough? To the extent that when you now, for example, now you may be having customs, domestic tax, and all those data sets. So tomorrow you're going to want mobile money data. Will that infrastructure be able to take that in? As your IFRIS or EBM data grows, will it be able to take that in? And this infrastructure I'm talking about should be infrastructure that stands and allows the other operating systems to keep moving. So those are either the lakes or the warehouses or whatever you'd like it to be, but let it be a platform that can allow you to grow over time. So that's about the technology. Look at the technology. I'll now get to the skills. I am hoping that we are not expecting that each and every one in the institution, revenue administration or whatever institution, is going to do this data analytics. The time I was in revenue administration, we had data coming in into domestic taxes, into research. Everyone was analyzing. And I think that needs, I don't know if it has changed, but that needs to change. Not everyone is going to do analysis of that third-party data. And why? Because you need to have a method that you can fall back on, that you can amend, that you can change, that you can query. So have where this data is going to sit and train people. So you need to train data engineers, data analysts. So the data engineers are going to develop databases out of this data as it comes in. Because remember, you'll get daily data, monthly data, quarterly data. So depending on the frequency, they'll keep updating these databases and also developing the master data management process that will help you avail these databases in formats, in tables that you can now analyze and get insights. So that is very key. And let's not mix that part up with IT, because IT will develop yes, there's a small line between IT and those ones, but those ones are looking at data. And you need to invest in those skills in order for us to deal with the risk, the registration, and all those things. So you need to have an oversight committee that reports to management, that has an oversight on this. And why? Because there are different interests. If we look at tax administration, the domestic tax has different interests, the customs has different interests, and different. So do you have an oversight function that supports these skilled staff? And this skilled staff should be, I wouldn't want to say special in a way, but should be treated in a way that this information doesn't leak. We know in revenue administration, this can be a source of a lot of challenge, because there will be a lot of insights in terms of potential revenue. So you need to really focus on this team. Data quality and standards. You need to look at that data as it comes in. Is it complete? Is it in a standard format? So you need to have the validation protocols, the formats, and I've talked about the master data management. Then identify priority data sets. You're not going to do all this at a go. What are the priority data sets that you start with? If you try to eat the whole elephant, you will not manage. So look at what will be a quick win. Yeah. And here I also want to say, also look at the very data sets that are within the tax administration. Analyze that customs data. Analyze the data on lands. If you have revenue administrations that are collecting non-tax revenue, that non-tax revenue is a source of a lot of insights. So even before we go out to the third party, have a specific function that is doing that analysis. And like our colleague earlier from World Bank said, you need that sandbox kind of thing. I know revenue administration will say we don't have resources, but this is an investment you must make. That sandbox team that will do that analysis and then provide the insights to the rest. Because like we've seen this third-party data, it comes, Leila has talked about it, different people collect data in different mandates. They will not have, so you don't want to misunderstand that data and raise an assessment. So you need a team that is focusing and will be able to really decode this data and bring out the insights. Okay. Very quickly, the collaboration with the data providers is very key. Keep engaging them. Pay attention to privacy and security concerns. As you're working on this data within the institution, monitor and evaluate impact. Wise talked about it here yesterday. It's very important. What is the impact of the third-party data on the revenues? It is important that you're able to do that. And then promote taxpayer awareness. Tell these taxpayers that we are accessing the third-party data automatically. People will align themselves. When they know you're accessing this data, it will reduce the cost of compliance. I can see Doris is looking at me, so you can engage me later and we can talk more. Thank you.
Millie is very, very, very passionate about all these issues, and she's had a long history of tax administration and putting this in practice. But I hope that we have tickled you and that you have been provoked to ask us some questions, to make some comments, so I'll open it up to you to hear your own perspectives. We'll take 3 questions, and if we have time, then we can...
Okay, I'll be as quick as possible. Millie is clearly very passionate, and she said something that I think is very important that has kind of puzzled me for a while, and is that, when you try to access the information from other MDAs, you have to entice them to share them with you. You have to share the tax administration data, and you have to show to them that the data that you hold can be useful to them. And that is probably a good way of kind of convince them that there is something for them to be gained in the partnership. It's always been quite hard to imagine what that could be in many cases, though. Like I have tried in particular countries to imagine, if I wanted to get access to some of the data from the central bank, what would the central bank gain from having access to the data of the revenue authority? Could your tax compliance become some form of credit scoring, or what is there to be gained from a central bank perspective? And then Laila mentioned very similar things about trying to get data from counties in Kenya, and I've done some work in Kenya, and I was also wondering, what is to be gained from local governments in having access from tax compliance data from central government. So, I would really be curious to hear your thoughts about, what is to be gained from other institutions, from other level of government, in having access to tax administrative data. Thank you.
Mm-hmm. Thank you for the great presentation. I have a lot of comments on Kenya, but I'd like to start by saying what Millie said on utilizing internal data first is really critical. We are currently doing a study with the help of ATAF, and in the wealth report it states that we have 7,200 high net worth individuals, but just from the analysis of the data, you can immediately tell that the 7,200 is not as accurate. So even as we are going to get third-party data, I think we have to be really careful on what we get and what we utilize. When it comes to the Business Registration Service and Ministry of Lands, we try to get a win-win from KRA's perspective. So with Business Registration Service, their struggle was in getting the PIN numbers at the point of registration. So what the Business Transformation Office did is that they had some of colleagues from KRA work with the Business Registration Service to get to help them in the process. So you would register your company, and as you're done with the registration process, you are actually leaving with a PIN number as well. So to Millie, I wanted to find out if there's been a similar working collaboration in URA, and whether the central bank in Uganda is making any of such collaborations. We also had something similar with Ministry of Lands, where KRA was collecting stamp duty on behalf of the Ministry of Lands. So do you have such arrangements, a win-win situation, where you're able to get the data, not necessarily from the third party, but you're getting it at the source through the process?
Okay, thank you very much, Millie, for being so passionate about data analytics. So just a quick question. Does it really matter where the centralized data analytics function sits? There has been several models, no? There have been several models. Some thinking it should be within the ICT department. Others think it should be within the research, planning, strategy department. Others think it should be independent, although it's already a centralized data analytics function or department. So does it really matter where it sits to make it more effective?
Okay. So we have 3 questions from the floor. I think we can take them in the order for Elia, then we'll come to Laila, and then we'll come to Millie.
I'll take the last one from Philip. Yes, I think it does matter where the function sits. The recommended setup is where it's separate, and then you can marry it with your compliance risk management. So in our case, how it started was within our research department, there's the statistics unit where I am. So we started a project for big data analytics. So that project was done in collaboration with GIZ. So now what that it's a warehousing system that we developed internally. So what that system does that it collects all the data internally, because the domestic tax system and the customs tax systems traditionally are siloed, they're separate. So now with that analytics tool that we developed, we are able to have, at a click of a button, all the activities of a taxpayer on the customs side and on the domestic side. But once the project was implemented, there was a strong recommendation that we need to create a data analytics department whose sole mandate would be to just do data analytics. So we created a new department. The statistics has to remain. Ours more of the statistics just to data insights. What is the data saying? Do research and things like that. But the data analytics, it has to be a dedicated function that should be separated from the traditional departments that we were accustomed to. And maybe the only thing you can add to it is the compliance risk management function, because compliance risk management and data analytics sort of go hand in hand. So that's been the experience, and I think it's bearing a lot of fruit. We can engage bilaterally, we can share experiences, but that is maybe a recommended approach on how to handle data analytics within the space of tax administration. Thank you.
Okay. So there was a question that was asked about the importance of local government in terms of their collection of data and how that supports the national government, if I got it correctly. Do you want to probably repeat it if I haven't? Okay.
What is the need for them?
What is the need for the citizen or the local government?
The local government.
The local government. Okay. So look, we're all pushing towards digitalization, and we want to do so in a manner that's very inclusive. Now, we always have a problem with the social contract. We do not trust the state. We've got issues of legitimacy around this. So the buy-in for the local government at this stage is that if we're asking for your data, is because then we want to come up with an own source reporting template that's going to give you the sort of tax transparency that is coming from us. And I'll give you the example of Nairobi City Council, right? They have their own source revenue reporting, but it is so ambiguous and vague. It doesn't really give you disaggregated data in terms of how many properties are there in, for example, Westlands and Parklands, and are they commercial properties, are they residential properties, and have you collected land rent and rate from all these particular businesses within these localities. What you're going to get is that the local authority is going to report to the Auditor General's office to say, in total, we have collected an X amount in property rates and rent, but there's nothing to basically tell us from who and how, and whether there are certain businesses that have not been captured. And that causes a lot of frustration for Nairobi residents, because you're like, you want to now come up with increased business permit costs, you want to come up with increased parking charges, but we're not really seeing the commensurate redistributed benefits within our localities. So the buy-in for the local government is, come and share your data with us. Tell us that you're the ones who own, for example, all these properties in Westlands, Parklands, Muthaiga, etc. And on the basis of that, we're going to provide you with a very clear, disaggregated own source revenue reporting template where you're able to now see exactly what we're collecting our taxes on, what we're doing with that, and how we're also reporting this to the national government. So I think it creates that legitimacy and that trust within the devolved unit, which then translates into broader trust with the national government. That's my take.
Thank you. Millie?
Thank you so much. I think I'll start from that. What is in it for central bank if we are sharing information? And we have a number of examples. The central bank uses trade customs data to get economic trends. The central bank is interested in the IFRS data to get, again, how is the economy performing. And also, this data that comes from the Revenue Administration would be able to give us pointers on things like financial inclusion, inclusiveness, and all those. So there's definitely something for the central bank to gain. A number of these, some of these statistics we compile manually using surveys. So if we are able to access information, then we will be able to have a wholesome. So there's definitely something to benefit on either side. Then the question from Damakrin on collaboration with URA. Yes, as Central Bank, we are collaborating. Already I've talked about the trade and customs statistics. Actually, what happens is when the month has ended, the statistics are put together, and there's kind of a committee between the central bank, the Bureau of Statistics, and Revenue Administration. So as we are looking at that data, we also support in cleaning up, and because you find that because Revenue Administration is looking at the revenues, a number of times the side of exports and there are some issues in there, some outliers, and so we really support each other in that area. We also share informal cross-border trade that does not go through the Revenue Administration system, but is information that they would be interested in expanding the tax base. So there's sharing going on. However, I must say that We are also still in discussions because that issue I talked about, the trust, what if the information leaks, what happens? So it's very important that on either side, we are sure, and that's why I was talking about that sandbox kind of team, that if information goes, it's not going to each and every one, and we can kind of control. So right now, what we're looking at is sharing aggregate information by sector, by region, in some of those areas that we are interested in, as we both work on how do we ensure that this information, if it comes granular, it will not disappear. And allow me, Doris, to smuggle in one that I missed in the other part. When you're training, friends, let's not only look at analysts and data engineers, it's also important to train everyone. For example, if we have a system that has dashboards, we need to train right from the Commissioner General down to the staff that are going to be accessing and getting insights from these dashboards, because again, not everything will be done by that small pack of analysts. Thank you.
Thank you so much for those questions. In the interest of time, I'll not allow another round. But I think we can all agree that from a tax administration perspective, the era of data utilization is with us, and data exchange is a critical part of that. Underlying successful interinstitutional collaboration is governance frameworks that we've had. It's important for us to have the right policies that enable this exchange of data, that also build trust when among institutions that are sharing the data, that the data will be properly used. We need also to invest, something we've not really talked about in this conference yet. We need to invest in the right human capital skills, skill sets, because the tax administration of the future is not going to use the skills of the past, because we are playing in a different field right now. Data sources should be wide enough, inclusive, very comprehensive. They should look at what we typically do not think as obvious sources as tax administrations. Instead of looking at our typical third-party sources within government, we need also to put our ears on the ground and hear what the public is saying through those avenues where the public hold a lot of discussions about things that happen on the ground that perhaps we do not hear about. Data exchange makes doing business easier, but also smarter, because it helps with elimination of duplication, and it also has the, call it the trickle-down effect of maturing e-government initiatives, because some government departments are ahead of others, but because of this requirement of integration, there's going to be a whole of government improvement in the technological and infrastructural maturity. Legal frameworks, technology infrastructure, financial investment in data sharing are critical enablers, and if all these boxes are ticked, change management is something that is not overlooked. We can safely say that I think the future of data exchange systems for effective and efficient tax administration is within sight. Thank you very much for your attention, and thank you to the panelists. Thank you.
Thank you very much to our moderator and our panelists. We're going to take a quick coffee break. But while we are taking that break, please, there's going to be a QR code which is going to be displayed on the screen. If you could please use that so that you can give us feedback on the conference and what your expectations were and how we can best improve. Our coffee break is going to be for 30 minutes. 30 minutes. 30 minutes, and we get right back in so that we can have wrap up last panel, please. Thank you. to be on future developments of digitalization in tax administration, from digital public infrastructure to other emerging solutions. Our panelists are going to be, and if you could please come to the stage and take a seat as I call you up. Our panelists will be Mustafa Ndajio, founder of African Center for Tax and Governance; Louise Kalisa, our Commissioner for IT and Digital Transformation at RRA; Philip Carbo, Senior Director of Monitoring, Research and Planning Department at the National Revenue Authority of Sierra Leone; and Mr. Daniel Munge, Chief Manager of ICT Business Solutions Development from the Kenya Revenue Authority. Our moderator, I don't know if I introduced you, Antonia. Our moderator is going to be Antonia Estreshi from the East Africa Regional Tax Advisor. She's a East African Regional Tax Advisor from the Foreign Commonwealth and Development Office, or the FCDO. Welcome to the panelists and welcome to our moderator. Please, the ball is in your court. Have fun.
Thank you so much, Master of Ceremonies. So, as was introduced, we're not going to have a long scene setter for this session because the conference itself is the scene setter for this session. But I am going to take a couple of minutes to introduce the key themes of what we're going to discuss over the next hour. And then I will pose some questions to our eminent panelists. So I think we've seen over the course of this conference, there's been a huge amount that we've learned, a huge amount of questions that have been answered, but also many more questions that we don't yet have the answers to. We know that digitalization is critical for effective taxation, but often the efforts at reform in this space fall short of the ambition. There's a whole set of reasons why reforms fall short of the intended objectives. Sometimes that can be to do with technical issues. Sometimes it can be to do with gaps in the holistic reform process, including on skills and other types of institutional challenges that have been discussed. So technology is a tool for reform, but it's not the only component of successful reforms on tax and digitalization. We know that there are some established characteristics of good reforms in this area. One of those, of course, is where you have reforms that are simple. They need to be cost effective. They need to be aligned to business processes, as we heard discussed earlier today. We need for the systems to be sustainable in the long term, both financially and in other respects. They need to be aligned to other legal reforms, to the administrative skills in institutions, and we need to make sure that there are mechanisms for institutional cooperation and data sharing, as we discussed before the coffee break. But going into the future, we need to know how governments can assess what good looks like in technological transformation, and we need to set the conditions for that success to be achieved, for example, through institutional cooperation. So in this panel, we have a set of officials who've been on the front line of these reforms, and we're very keen to hear from them how we achieve effective digital transformations. So let me pose, let's first hear from a few reflections from everybody on the panel, and then I will ask a few questions. So let me turn first on my left to Louise, if I can hand over to you. Thank you so much.
Thank you. Thank you, Antonia, and good afternoon, everyone. You said it well. In the course of these 2 days, we have had again and again the importance of a digital transformation. But also, especially in the last session the last discussion before we went to the coffee break, about how it's very important to have a collaboration between different agencies, being public but also private institution as well when it comes to data sharing, but also knowing why you are collecting data or you are receiving data from other institutions. For me, I wanted to share a bit about our transformation journey in Rwanda, but in particular in Rwanda Revenue Authority. Most of the time, now we know technology is a tool, technology is an enabler, but most of the time we don't look at what were we trying to resolve when we started the journey. And that's, for me, that will bring to, let's say 22 years ago, because again, Rwanda Revenue is a relatively young institution because it's only have been around for the last 25 years. And when we look at when it started and when people, for example, if someone would want to start a business, the challenge that were there, first you'll have to come to the offices to do your registration. You understand? Someone want to start a business, that's their purpose, but you need to travel to a Rwanda Revenue Authority to do your registration to get a taxpayer identification number. Then you go do your business, then it's a time for filing, for example. For me, there's an image in my head. When I was in high school, we were passing our way to the school. We were passing to a VAT office of RRA. Back then, it was, I think, 1999 or maybe 2000, early 2000, and going to school will be really early, before 7, but there will be a long queue of people that were waiting to do their filing or to get any service. For me, when growing up, before I came to work with RRA was a place where there would be a lot of people that were queuing to get service. So really the digital transformation is, for me, the journey is to resolve all the issues. And I'm not talking about, for example, people in trade who will want to import something or export something and will have to go through multiple agencies that are to get some approvals and permits. And you take maybe days, weeks to get all those before you do the real transaction, which is importation or export. And that's for the public, for what I can call the customers. I'm not even touching how digital transformation has helped has transformed the efficiency of the tax administration itself. For me to read that's the experience. That's what, for me, the digital transformation is. And of course, tackling different issues like tax evasion and other challenges that tax administration was meeting then before this journey started.
Thank you so much for those reflections. And it's an image that I hear living in Kigali, people refer to over and over and over again, that back in the day you used to have queues around the block outside RRA offices, and you just don't see that anymore. Yeah. And I can be a witness to that as a resident of Kigali. I've never seen a queue outside of an RRA office, as far as I know. Let's move on to our next panelist. Mustafa, if we could have your inputs, please. Thank you.
Thank you very much. So I think a lot has been said about, the focus on, just technology, and knowing that, technology alone is not, a silver bullet. but if you look at, particularly African countries, I think one of the reasons why, there's a lot of focus on just getting that technology is a few things. One, it's because it was largely driven by, the need to address, tax non-compliance. So there was that, rapid, intervention that was required. So, and then, countries are under pressure as well. But there was no investment in strategy. It was more, let's just get, once we get this application or once we get this software, our taxes will increase from 500 to 1,000. But that was largely, I think, what led us to, getting all these off-the-shelf softwares and, just because somebody will come and just tell you that, once you install this software, we get more taxes. But, down the road we realized that it doesn't work that way. And I think a lot of countries have now started investing significantly in strategic planning. You see SARS, KRA, you go online, you even see their strategic plans. In the past, you don't even see this. So I think that focus on digitization, which was somewhat confused for digital transformation, is one of the reasons why we're here today. But I think going forward, we at the ACTG we're trying to come up with a project on digital maturity. So we've seen there's a digital maturity index at the OECD, which kinds of it's a self-assessment tool, which gives you an idea of where you are. And I think tools like that will really help revenue authorities know where they are and what needs to be done, because it's kind of holistic. But largely the problem is in the strategy, is in the lack of strategy. So if you invest in the strategic plan, like she was saying, what are the objectives? What are you trying to do? What problem are you trying to solve? It's not just about tax collection. Are you looking at it holistically? Who is going to work on this software or systems that you have? Who are the users? Is it user-centric? The approach to developing it. So these are all some of the things that we've seen. In Nigeria, we've seen FIRS, just like the previous speaker was, I think, from Zambia, that they developed in-house. Same thing in Nigeria. The FIRS also developed their Tax Pro Max in-house, and they learned from the previous mistakes. Because I used to work at the FIRS. I know we spent millions of dollars on a software that did not work, and it's because we didn't take the necessary steps. We didn't do the strategy. We just thought once we got this software from Canada, and that since it's from Canada, it's going to work. But it didn't work. Years down the line, we had to abandon it, and now it's not been easy even developing it, in-house. It has its challenges where you have staff trying to own the systems themselves rather than think of it as an organizational thing. But by and large, I think once you invest in strategy and you develop a strategy around it, it's really helpful from what I've seen. Thank you.
Thank you so much, and thanks for touching on, I think, one of the really critical decisions for revenue authorities in this space about whether to purchase systems off the shelf or whether to develop them in-house, and all of the factors that you have to take into account when making those decisions. So thank you for those comments. So let's move along the line. Over to the next, please. Thank you.
Thank you very much, Sonia. So yes, there's a lot that has been said in the past 2 days when it comes to this digitalization conference. And I think I want to weigh in on the area of change management. We know, of course, over the past 15 years, almost every African country, every tax administration has moved towards digitalization, which, despite the challenges, remain very much important for ensuring we are able to deliver on service delivery, we're able to have access to data to improve on compliance and eventually improve revenue mobilization. But as we implement most of the systems, there are always issues in terms of the acceptability of the reforms we have to implement. I think what I've seen here is there's a difference between there are criteria that can actually, there are reforms that are likely to be accepted and those that are not likely to be accepted or be resisted against. And it actually relates to whether the reform is actually for service delivery or the reform being implemented, the digitalization is actually for revenue mobilization. Now, what we did in Sierra Leone over the past year, in fact, for the past 7 years, just as with many countries, Sierra Leone has been like a works yard for reforms. We implemented several reforms ranging from customs, migrating from Asikuda plus to Asikuda Wall, implementing ITAS for e-filing, and then implementing electronic fiscal device, as well as even an electronic single window relating to as an offshoot of the Asikuda. When all of these reforms, when you look at the reforms that relate to taxpayer, to improving taxpayer services, they are likely to be accepted by taxpayers. So when we roll out ITAS, because ITAS helps the taxpayers to actually do online filing. And when we roll out Asikuda, because actually we improved some other functionalities, it was to the advantage of the taxpayer. We didn't get any resistance from the taxpayer. But when it came to implementation of electronic fiscal device, because the taxpayers were, of course, of the notion that what they were not declaring, that the revenue authority will be able to see that now. So which implies they are likely to pay more, and that will affect their revenues. So those ones who had strict restriction, who had strict resistance to its implementation. So these are the two. So in terms of resistance and which one is not accepted, sometimes it depends on the purpose of the software. And this is where we had issues. And so as we weigh in on change management, we also want to talk about whether there was training or not training. Because sometimes when we roll out these reforms, we forget about training the taxpayers. In fact, for the smaller taxpayers, they're likely to resist because they think they have some anticipation that the system being implemented, they might find difficulty in understanding it, or in fact, it may affect their own privacy in terms of data privacy. And when that happens, it makes it difficult for them to actually comply in terms of accepting the reforms. Even though taxpayer education may be there as one of the ways for which you can improve for which you can improve change management, but then if they are not well trained, or the purpose for which the software is done, then it becomes a challenge. I also want to weigh in on the area of vendor locking. Some of the systems we are implementing are vendor-based systems. And when you look at them, because the vendors will not give us the source code for these systems, it makes it very difficult for us to do any improvement in the data. And that's why yesterday, I think there was a session where somebody spoke about cost effectiveness being one of the reasons that will actually drive the system being used. So that is one particular thing. So when it comes to the vendor-based system, so because for any change or any development you want to make in the system, they'll charge you a change, ask for a change request. And when they ask for a change request, you're required to pay. So that's why going forward, you can see that most countries are now developing own systems. But again, that one has advantages, of course, disadvantages. One, of course, the cost effectiveness. You're able to improve on any development you want to make, you're able to do that. But then there are issues of having a strong ICT system, the ICT department, and that's why capacity involves. Because if you have to develop your own system, you must have a strong arsenal of ICT staff who will be developers who will be able to improve on that system and develop a strong and robust system that is tested. But also issues of security, because for some of these systems that are being implemented, they may not have been tested in terms of security or cyber security. And when that happens, then that becomes an issue. I had a discussion with the Zambia Revenue Authority because they have just moved from the ITAS, which was a vendor-based system, to now developing their own system. I was asking them, what is the challenge you're facing? Because you have to move your data. I'm thinking about data migration from a vendor-based system to a system that is different, that is developed by themselves. So these are some of the challenges that we want to also explain as we talk.
Thank you very much indeed, Philip, and thank you for touching on the point about it's not good enough for us to focus on training tax officials alone. We also have to think about training taxpayers so that they can interact with the new systems. So thank you so much. So now for our final first comments, we will move right to the end. So over to you, Daniel.
Okay, thank you. Thank you very much, Antonio. And for me, I think I'll start first with the journey. And the journey, what we hope to achieve finally is simplification for the purpose of the taxpayer, as well as visibility for the tax authority for purposes of revenue enhancement. So, like Luis has indicated, previously we actually used to have those long and paper-based manual processes that were really onerous for the taxpayer. But over time, we've been able to provide online forms, which now taxpayers are able to file their returns from the comfort of wherever it is that they are seated. But from an aspiration perspective, when you look at tax administration 3.0, the expectation is ideally these tax processes should be happening from within the taxpayer ecosystems. That is, whatever business taxpayers do and whatever system it is that they should do, then those particular systems should then be able to talk back to the tax system and also be able to complete their tax affairs. So what does that then mean for the tax authorities? Then for the tax authorities, it means we have to look outside in and also start to build collaborations with the technical people or the technology people who actually build solutions for the taxpayer. And that collaboration will be by way of now the tax authorities being able to develop and expose APIs, which then these developers of the taxpayers can then embed so that we have that seamless integration. I know in the front of integration, we've actually been able to do quite a bit. For example, in terms of being able to get payments and also this being actually a journey, gradually being able, for example, to integrate with some of the government organizations for maybe payroll, for payments to government suppliers also. And then these particular ones are also required also to find their way into taxpayer returns for purposes of now pre-population and also easing that burden. Then secondly, on the visibility bit, we as tax authorities actually would gain a lot, like in the Ghana example, where you actually get the financial transactions that can actually inform what the taxpayer activity looks like for purposes even of estimating their activities. In this also, what that means is also we'll need to have some sector-specific interventions. For example, besides that one with banking, in Kenya, for example, we've also been able to do something along the lines of betting and gaming, where we're able to get that information and also being able to collect those taxes on a next-day basis. So I think for me, this digital transformation goes beyond just within the tax authority, but also a collaboration now with the third-party developers and also the service providers for the taxpayers, so that we have this being an end-to-end process, which eventually taxpayers should be able to do much of their tax affairs from within the systems that they use to do their businesses. Thank you.
Thank you so much, Daniel. And I think a very important point about the pressure for revenue authorities to develop tools for taxpayers that are within their digital ecosystem so that it's easy and convenient for taxpayers to make payments with the tools that they use every day. So now I'm going to pose, I hope, some challenging questions to our panelists about where we've got to and what's next. So could you give us some of your reflections about the top 3 challenges that you've experienced in the digital transformation process? And to give you a heads up, we will also come on in the next round to your thoughts and lessons learned on the secrets of success for a digital transformation. But let's start with your top 3 challenges, and we'll go in the same order.
Thank you, Antonia. For us, really, the challenges are many, but if I think of the top 3, I would say the first one is digital literacy and access to technology, because everything that we are doing, really, you are doing it. At the end, we want to simplify the journey of our taxpayers. But if you are putting out there digital services, digital tools, but your taxpayers are not able to use them, then it becomes a challenge. So that means that the digital transformation journey needs, and I think one of the colleagues talked about it, you need to take along your taxpayers. But there's also a need of a national strategy when it comes to access now to technology, because you don't want the person that you didn't want to come and queue at your office. You don't want that same person to walk 10 kilometers to access the tool that you have put that you have put up to help them. So for me, the first challenge in the journey is the digital literacy, and again, it also touches your staff, internal staff. They need to be trained so that they can be able to use the tools that you are building. You need to have the skills to, for example, to analyze the data that you are collecting. So that's one. Second one is retaining your skills. We are all talking about vendor locking, off-shelf system are not the solution. But when you start now developing your systems, you need strategies to retain your staff, developers, those data scientists and data auditors. So there are those specific skills that you need when you are in this journey that requires more than the simple, I think, benefit like salaries. Because again, at the end of the day, you find tax administration and public institutions. You train someone, a bank will come and double their salaries. So you need to come up with other strategies, and that's also, I feel like that's another challenge that you meet through this journey. Another one, but I think it's more or less common on our continent, is the cost of technology, the cost of the digital transformation. It doesn't come cheap. So you need strategies to raise the funding, build your case with your Ministry of Finance so that you can get the finances that is needed, but also work closely with developing partners where possible, so that you can have other support, not only from your government. For me, those are the top 3 that I can think of. Thank you.
Fantastic. Thank you so much. Yes, and if everybody could try and be as concise as Louise, that would be wonderful. So,
yeah,
yes,
thank you. Yeah, so I could easily just repeat what she said, and that would be my top 3 challenges as well. But let me, just focus on other things. Like I said earlier, this mistake of thinking digitization is digitalization, or digital transformation is one of the major challenges, and we still do that till today. Because rather than look at innovation as something that should generally increase efficiency, within tax administration, we are focusing on, tax collection, plugging this loophole and whatnot. And I think it's one of the major problems that we have, if you look at it from a strategic, point of view. And if you work in strategy and you interface with this every day, it's really, really annoying because you know what you're supposed to do. And if you're unable to put those building blocks, in place, it's going to fail. And no matter, but then you keep screaming and then nobody hears, what you're saying. So I see that as a big problem, understandably, because like I said, most African countries that introduced these systems were always under pressure, and there was the belief that once you introduce this, taxes will go. And in the first year, 2 years, you see that these taxes they will definitely increase because you've introduced the system. But the underlying issue is compliance, and technology is not necessarily what is going to make somebody, a taxpayer, comply. There are those major factors, fiscal legitimacy, motivation to pay taxes. So if those things are not, even when as you're building systems, because if you look at the private sector and the public sector, the distance between where technology is still very, very far. Taking machine learning, and then in tax administration, they're still struggling with, registering taxpayers. And so there's a significant, gap. So major focus, and I think if you understand that technology is just an enabler, to bring about, general efficiency, I think that would be, one very, very important step towards, addressing this. So I see that as a big problem and a foundational problem. The other thing is, interagency collaboration. While there's been a lot of, improvements towards interagency collaborations, one of the challenges and the risks that are coming now is because the more you integrate, the higher your security risks and the higher issues with, issues of data privacy. And I don't think, tax administrations, particularly in our countries, have invested significantly in these areas. And like someone said, change management, very, very important. And just tie that into, capacity needs. You're building. We are focusing on the elite. We're building elite systems that may not be used by a significant portion of the population. So I see these as very, very fundamental challenges. Thank you.
Okay. Perfect. Thank you so much.
Okay, from my end, I don't know if there's anything new because they're the same challenges we're talking about, but maybe I'll put them in a different context. So yes, when you talk about capacity challenge, that's one is paramount. In as much as we're rolling out reforms, looking at how we can make use of data from these digitalized systems, obviously challenges are obvious. And so I'll not talk about the ICT challenges because they're obvious. In my country, Israel, the staff turnover from the IT department is quite high. So in fact, we should be thinking of maybe having a retention strategy. So some countries that may have had a retention strategy of their ICT staff, maybe they could help us share that. How did they retain their staff? Because every now and then they are leaving. They get pushed elsewhere and they are just taken away. So getting these guys, even after you think you have capacitated them, they are now filled with the systems they are rolling out, all of a sudden they get taken away. So how these guys retain maybe one thing. So I'll not talk much on that. But I think on capacity, let's also talk about procurement issues. We also, the systems we are rolling out, most of them are, especially the vendor-based systems, they are quite sophisticated. So usually we do not have the capacity within to understand, in terms of procurement, how to understand how these things should be procured. And if you look at most of these systems, they are mostly funded from donors as well. It can be from the World Bank, from FCDO, and these guys have their own sophistication, and they have their own bureaucracy when it comes to procurement. So we usually have procurement challenges when it comes to capacity. So if your procurement team is not quite capacitated enough to deal with these sophisticated systems, it also becomes an issue. But also let's talk about the fact that we are sometimes revenue administrations are most times ahead of the other MDAs, other agencies that may want to integrate, whether for interoperability of the systems or for data exchange. And that is the problem we are facing in Israel. For most of the systems, we have now done the ITAS, we have done the data warehouse, We're now integrated. It's now a central repository of all data from all the internal systems. But now we want to see whether we can now draw data from third party. But most of the MDAs that want to integrate, it's only now they are developing their systems. So in as much as we may want to get the third party data, the fact that these MDAs, these ministries, departments, and agencies, they are still way behind when it comes to automation or digitalization, makes it difficult for us to actually integrate. And the last thing I want to talk about is the lack of a data management strategy. I think we discussed that immensely during these workshops, because it's not that you just want to deal with data management. I think it's very important to have the strategy. The strategy will guide us on what we actually have to make use of data. Because for most of us, like for Sierra Leone, for instance, we have already started, we set up data analytics units, but yet we do not have a strategy on how we can do data governance, on how we can make use of the data, on the data privacy issues, on data security, on other things. So it's very important that in as much as we are talking about digitalization and making use of the data, it's important that we have a data management strategy that can actually help us manage it.
Wonderful. Thank you so much.
Okay. For me, I would look at the challenges, but they'll still be from a technology perspective. And I think one of the things that slow down digitization, for example, would be the fact that revenue authorities still have legacy systems within themselves, while at the same time we still want to have this data for these integrations for purposes of being able to get the feasibility. So, and what that means then would mean that we need to have the interfacing integration platforms to be able to do that. And then with this data that comes the other challenge in terms of now capacity in terms of the infrastructure that you would need to be able to manage this kind of data. Because assuming traditionally you are using a regular data warehouse, and then we're going into the big data space where you need to have some lakehouse infrastructure set up for purposes of receiving this data. Then comes the capacity challenge in terms of once you have this data, do you have the skills to be able to analyze and make sense out of it? We speak AI, we actually need to build into risk engines, for example, that can feed back into customs processes for risk profiling, or even in terms of in domestic revenue where you're profiling taxpayers for that purpose. So that capacity in terms of being able to get the eventual output of why this digitization, because at the end of the day, it must result in some revenue for the revenue authority, and also it must result in a benefit for the taxpayer by way of simplification in that they don't necessarily still have to recapture everything that had already been sent back to you. So I would look at that challenge. Then the other item also is from a policy perspective is in these data exchanges, there is actually the pushback largely on account of data protection, which I think I was glad to hear that Ghana seems to have been able to overcome this, but that still becomes a challenge that also needs to be addressed so that you can get a holistic access to the data that can then help inform the revenues, the revenue authorities' processes. Thank you.
Brilliant. A really diverse and insightful set of challenges, I think, there. So thank you, everybody. I'm conscious that we're going to want to have some time to take questions from the floor. But before we move on to the floor, maybe if I could ask you all to give your one top tip for successful digital transformation. If you can express it in one sentence, maybe. I know that's perhaps a bit of a challenge, but I'll give you a few moments to think about it. And then we can move on to questions from the floor. And maybe to be fair, let's start at the other end of the panelists this time. So back to you, Daniel. What would your one top tip for successful digital transformation be?
Yeah, thank you. I think for me, picking from yesterday's conversation, the alignment of business, the business requirement. Why are we doing what we need to do? If we have that answer right and in a manner that it is in the simplest way possible, I think that would be my top.
Fantastic. Yes.
That's right. Mine will be like having a whole of government approach in the digitalization journey, because at the end of the day, if we just operate in silos, the revenue authorities will just say this is the way we want to go, and then government, if other institutions, other MDAs are not quite also of pay with what is happening, it becomes very difficult. So if you have a whole of government approach, it's taken right from the political level, and it becomes like a whole of government involvement in digitalization. I think that's the way forward. Otherwise, it will be difficult for us to integrate our systems. It's difficult for us to have access to data. There will be possibility of resistance, change management issues. But if you have a whole of government approach, I think that's the way forward in terms of digitalization.
So for me, I think have an inclusive digital transformation strategy, and ensure, there should be commitment from leadership. I think once you have that, we'll address most of the issues, starting with the digital transformation strategy that is inclusive.
Thank you.
Not easy to say, to have this in one sentence, but I would say that digital transformation starts with a mindset shift. And it's very important to collaborate, especially when it comes to tax administration. Most of the time, there's another tax administration that went through what you're going through. It's very important to talk to each other and get the lesson from their journey. We don't really have, especially on the continent, we don't really have a lot of differences. We have a lot of similarities.
Wonderful. Thank you so much, Louise. So now we can turn to the floor for any questions for our eminent panel. Don't be shy. Yeah, I can see there's a hand over there.
Thank you so much for the wrap-up. It's been a very interesting 2 days to hear from everyone. We led the panel on the citizen side, and I've heard a couple of different ways in which the government tries to help citizens use digital means for paying tax and registering. And I think it seems to me that it's quite a top-down approach. And maybe I'd be interested to kind of find out what bottom-up approach do you apply when you're trying to understand what citizens need or want when it comes to digitalization of tax? What bottom-up approaches do you apply in designing for and with citizens?
Thank you. Are there any other questions? We can take a round of a couple. Or you're still thinking? Oh, there's one here. And another in the middle. There's another at the front here.
I would like to ask for digital payment for tax. Most of people, sometimes we need the people who don't have knowledge for digital payments, who need some skills to be provided to them. What are you providing to them so they can start to use those digital payments and they can track, see the balance, the transaction statement, how about teaching them and giving them the acquired skills so they can pay taxes when they are feeling comfortable? When you tell them, they say, oh, we do to pay by cash, but what are you going to do for them to know how to use those digital payments and they know how to track the records that they need?
Hello, thank you. So I'm going to go back to one of my key expectations for attending this conference. And it's not only for this conference, but I have been in tax administration for just 4 years, and I had a different thought. I had also an assignment in mind, right? So what I thought when I was coming into government, and the road to achieving that has been a lot of ups and downs. And I'm sure many of us here may have experienced that for so many years. Some of the ups and downs may be new to me, not very new to you. Some of them you will laugh over them. But for me, my thought process around taxes, right, is the moment I hear tax, the next thing that comes to mind is development, right? And I understand that tax is based on laws, right? And these laws mandate certain compliance measures to be fulfilled. For us to fulfill these laws, for us to get the money, for us to develop our countries. But it seems that these priorities, there's a disconnect between the government as a whole, when we talk about the executives, and then the practitioners, that is those of us who have to ensure that the right things are done for the collections to be done. And I get the sense that that impacts a lot on the emphasis, a lot of the time in Sub-Saharan Africa, on the focus on collections, because the government comes in and they are in a hurry to fulfill their manifestos, right? To quickly get money to service debts, get money to do certain key activities that fulfill these things. And in that hurry, right, we shift the focus from the core activities that should result in the relevant taxes that are supposed to be collected to drive the development of our nations, right? And so for me, the thought process has been, yes, in the technical areas, the what to do to be able to provide the technical support that will lead to these things are there, and we have all eloquently expressed these things. But for me, how do we bridge? It's been something that, I've found very difficult to bridge, to be able to bridge this disconnect between the practitioners and the government, right, or the executives, so that we understand that, because essentially, if the things we are talking about, how to think about digital transformation, how to think about strategically aligning data, right, or data-driven tax administration to our corporate strategies and all of that, right, very, very essential, right, to drive the sort of revenues we're looking at, right? But then we abandon those things and then go back to focus on collections instead of the things that will bring the collections or the full breadth of collections. So how do we, for me, I still haven't answered that question in my mind. How do we bridge that gap? How do we bring this as a matter of priority, right? Because year in year, they don't listen. And for me, I don't know if this needs a research or this is an answer of yes or no. Thank you.
Thank you. So maybe just to briefly recap on those three questions. We had one about how do revenue authorities reflect citizens' bottom-up preferences rather than giving them services top-down. We had a question about how do revenue authorities make digital payments easy? How do we teach taxpayers to use digital methods? And then finally, how do we deal with the tension between revenue authorities needing to collect revenues adhering to all of the rules and regulations, while at the same time coming under pressure from governments who want money quickly to deliver on their manifestos? So I don't know if anybody wants to jump in on any of those. Louise.
Yeah, thank you. I will try to respond to at least have some input on those questions. The first one is, now we have that strategy of bottom up. Maybe to share the experience, what we have been trying to do in RRA, because at the beginning, when you start your journey, you put a lot of systems there, but it's very important for at a point to pause and say, okay, who am I serving and how am I serving them? And I'll try to share what we have been trying to do, and that is involving taxpayers to understand their need. We have been working with our taxpayer services, and it's actually an initiative that they're driving to collect taxpayers' insight, what we call insight, or trying to see this is how a process is as it is now, and bring in taxpayers to understand what are the pain points, how do they, from their perspective, how are they seeing that process? It can be something like a service we know from a tax administration perspective is working perfectly, but we think that it's working perfectly, but when you bring in someone who uses it every day, they will show you another face all over. They will tell you, oh no, here, I don't even understand what you're trying to ask me. Here, I don't even know what I'm supposed to submit. And from there, we are trying to re-engineer our processes from what it is currently to now a new way where we are taking into consideration their needs and making really easy for them, which is different from how it was designed and developed from a tax administration perspective. We are now looking at having it from, especially the services that are facing taxpayers, having it from a taxpayer perspective. That's on what we're trying to do. But again, it's a journey, really. It's not something that is going to work to be done overnight, but it's something that you need to be intentional and involve them at each service that you want to put it up. Second, on the second question on digital payment, have different options. For me, that's what's is important. In our case, for example, taxpayers are able to pay using a mobile application, which doesn't really require much, but a phone, a feature phone, where you dial a certain USSD and you are able to pay. You are able to file, especially when you are a small or a micro taxpayer, to file, but also to pay. But there's also a part where we work with other stakeholders, like agents, where they can go and get those services. So have multiple ways your taxpayers can be able to pay using digital payment. We don't receive cash, by the way. So all the payments are done digitally, using different means. Now, the tension between tax administration and government. I think it's a journey as well. It's a journey. It requires a lot of consultation and also have a national level strategy. I think in Rwanda we are lucky, so I won't comment much on that because I feel like we have a good collaboration between us and the government, tax administration and the government. So let's say I don't have much experience on that, but I will let also other panelists talk about that. Thank you.
Okay.
Go ahead.
So maybe I just jump on that point because I've been in that mix, right? So I think one of the major things we need to unlearn as tax administration is the focus on collection rather than compliance, and this sort of dovetails into target setting. So every year you come and they say the FIRS or RRA is expected to collect X amount of money. So by design, your focus is on collection. But if the focus is on saying we want to increase the number of our taxpayers from 1,000 to 2,000, we want to increase the number of our filings from 5,000 to 6,000, rather than because with compliance the collection will come automatically, but focus is always on collection, and that's why in some cases you see that the already compliant taxpayer is forced to pay more because strategies aren't developed, to bring more people, because that's more difficult. It's easier to tax, those already in the net. But those are some of the, the issues that I think are bringing about. So I think if tax administrations will develop their strategies, focusing more on compliance, I think, and which is what registration, payment, filing, and reporting. If there is focus on these four things, eventually the collection will come rather than the other way around.
Yeah, so let me also add a bit. In terms of the last question, in terms of disconnects between practitioners as well as the executives, in terms of the intention for which the systems were actually implemented for. I think I'm a culprit here. As head of planning, strategy, as well as research, for some of the systems we roll out, the Minister of Finance may think, okay, I'm investing on this system with the hope that I get the revenue returns. And they've already, as part of this system, you may do from forecasting. But it's important that right at the beginning of the rollout, or even at the time you are planning the systems, you communicate clearly to the Minister of Finance that some of these systems will not have immediate revenue benefits. If you take instance of some of the systems, they are mostly compliance related. And for customs, for instance, is mostly for trade facilitation. But just that in the longer term, this will bring in the revenue. But for them, they want immediately implement the system, they want the revenue immediately. So this is what, so recently, 2 weeks before I came for this workshop, the minister charged me that we have implemented electronic fiscal devices, we have implemented ITAS, we implemented Asikoda. He has not seen the revenue benefit. So he now wants me to do an assessment of the impact of these reforms before he can talk about investing in further reforms. So these are things that happen, but it's important that I communicate to them that right from the beginning that the impact of some of these reforms may not be immediate in terms of the revenue focus, but that it may come in the long term through more trade facilitation, if it's Asikoda, or it says for ITAS, it's mostly compliance management. Once you have more of the data, you do data matching and do other things, that will be able to uncover more revenue. For things like electronic fiscal devices, they believe immediately you are able to bring in more returns, you are able to bring in more data, then that should yield revenue. So these are the things we have. So I think that's the way to do it, to communicate immediately to the minister so that he gets to understand the purpose for which reforms are actually being implemented. Otherwise, they only have the assumption that this will bring in immediate revenue.
Thank you. Thank you so much, Philip. We are over time, so I'm just going to give 30 seconds, Daniel, if you wanted to make any final comments, and then we'll close this session so that we have time for the closing remarks.
Okay, thank you. So I think on the last item in terms of working on collections and building for the future, I think the two things actually need to be looked at in parallel because we still have to do the business of the day and be able to collect to support government programs. But in the same breath, then what it means is what we are building to support the future or to fix the core and make sure that we have a solid ground going forward. Then that needs to be looked at in the long term. But necessarily, it would also mean that short-term interventions which need to be taken care of so that you're able to collect immediate revenue still have to be taken care of. So what that means is, essentially what I'm saying is we have to run the two in parallel. You have to run the near business as usual as a stream, and also your strategies to build for the future. Thank you.
Wonderful. Thank you so much, panelists, for I think what was a really rich discussion. If everybody could give a round of applause. And now I will hand back to the Master of Ceremonies.
Thank you, Dr. Antonia. So that was actually quite an interesting conversation, and I'm wondering, although maybe I'll ask about this on the side, for revenue authorities that are semi-autonomous, where we set our targets based on, for example, what the Ministry of Finance sets, then how do you go about that? How do you go about changing the strategy in terms of what your goal is then, or what your target should be? But yeah, as I said, this these are really conversation starters, and so we should network and have each other's contacts so that we can be able to keep them going as academics, but also as people who are serving the public. We are going to have our closing remarks. Firstly, we're going to be hearing from Martin Heersen from the ICTD, and then we'll close off with Ms. Louise Kalisa. Thank you.
Thanks, everyone. So just a few remarks to end with, based on my observations from the days. First to say, we're all here because we believe in the power of three things to make the world a better place. The first is tax, the second is research, and the third is digital technology. But none of those things are ends in themselves. We tax, well, for various reasons, but most crucially because it empowers the state to develop. We conduct research, sure, because we're curious, but also because we want to make the world a better place. We want to make sure the decision makers will see the findings that we generate. And similarly, what we've been reminded of here is that we digitalize for a purpose. And we must ask ourselves, what is the purpose of any given digitalization reform? The second thing I wanted to say is, I've been reminded, especially in the last few panels, that you can digitalize, you can introduce digital technology all you like, but ultimately, people are still at the heart of what we're doing here. Tax itself is not just a transaction. It's a citizen's relationship with the state. And so it's important to think about what the citizen knows, understands, perceives about the state. It's important to think about citizens' rights in thinking about the way in which we introduce digital technology. Inside the Revenue Authority, the most important resource is not any piece of digital technology, it's the people. And developing the right human capacity is essential to making digitalization work. And similarly, as Millie reminded us in talking about data exchange, it's not, when you build a data exchange between organizations, it's not just the technological interface that matters, but also the human interface, the soft things, as she said. So talking about people, I want to say a few thank yous. Let me begin by thanking our own team at ICTD. On the research side, a special thanks to Fabrizio, who's done so much work behind in the organization of the program. And then on the programmatic side, I'd like to thank Ollie, Ria, Sai, and on communications, Emily, Miko, and Steph, without whom we really couldn't function as a center. So thank you. Thanks to our hosts, the RRA, and I'd like to extend a special personal thanks for the dance show last night. On the RRA side, I'd like to thank Jean-Paulin, Judith, Giselle, Jean-Bosco, and the media team. Thanks also to the AV team over there, and thanks to Ukwezi, our amazing MC. Of course, thank you to our donors at the ICTD, without whom we wouldn't be resourced to do any of the things that we do. So thanks to the Gates Foundation, the UK government, and the Norwegian government. And finally, just a reminder that this conference comes at the beginning of a new research journey for us on this topic. The survey that we asked you to complete includes a couple of questions asking you to suggest to us, are there particular bits of research that you would like the ICT to do, or that you would like to do with the ICTD? This is the moment to tell us. And similarly, are there particular audiences, particular policy makers, processes that you'd like us to take our research to that you think we're not currently engaged with? So please do let us know about that. So thank you very much. It's been a really fascinating couple of days, and I'll hand over now to Louise.
Thank you, Martin. Good afternoon. Mine really is, again, to thank ICTD for trusting us, for trusting Rwanda Revenue to co-host this conference. the theme of this year, which is toward the digital tax administration, lesson learned and directive for reform, I think it gave us a good platform to discuss and in deep how, as tax administration, but also different stakeholders, we can build on digital transformation for inclusion, efficiency, but also fairness. We have, together with all of you in the last 2 days, we have explored critical priorities such as data governance, third-party integration, and other emerging technologies like intelligent analytics to enhance compliance while ensuring equality. I think, though I've missed that part, I think last night also we had that celebration of our collaboration with ICT, which marked the 10-year of our collaboration. We have to recognize our partnership and different contribution it has made to our progress, especially in research and capacity building, which is one of the instrumental factor for success in our tax administration. We really look forward to continuing this partnership to even achieve a greater milestone. As we move forward, we, as Rwanda Revenue Authority, we commit to continuing advancing digital tax administration for the benefit of our economies and communities, turning different insights into actions that foster sustainable development. I hope that for all of us, for this conference has served as a springboard for fostering discourse among peers and partners across the tax ecosystem, while offering inspirations for evidence-based policy and innovative initiative that will help to leverage and impress in our respective countries. I cannot end this remark without, as you know, we are toward the end of the year. I hope that you take with you not only valuable insight, but also fond memories of our country's hospitality. For those who can, I encourage you to extend your stay and explore our country's vibrant culture that I hope you experienced yesterday, and our natural beauty and our weather as well for some of you that are coming from far. And with the holidays that are coming, I wish you a Merry Christmas for those who celebrate, and a Happy New Year. May the new year bring continued success, growth, and new opportunities for collaboration. For the ones that are leaving, travel safe, and I wish you all continued success in your endeavors. Thank you.